long and deep history in India. Some of our most loyal and energetic subscribers are based there. Not surprisingly, banks and government institutions have been with us the longest. In fact, the Reserve Bank of India has been one of our most consistent supporters, subscribing to the FT newspaper for more than 75 years. So far, in this important series, we've examined India's place in the world, focusing on government policies and business strategies that could put India back on the path of rapid, sustainable economic growth. Our second webinar explored the geopolitical elements that underlie these challenges, not least in the post-pandemic world. Today, we look at the banking and finance sector and just how important it will be to the pace of India's recovery once the world learns to coexist with Covid. The speed and shape of this global recovery will depend significantly on how quickly large and dynamic emerging markets like India can get back on their feet. India's fundamentals remain strong, with a giant consumer market, a youthful population, the rule of law, and a vibrant technology sector that's rapidly digitalizing finance and industry. India's banking sector, of course, is facing singular challenges, not least a ballooning non-performing loan burden. So, are recently announced reforms sufficient and in time to staunch and cure this problem? What opportunities does the boom in digital lending and payments present for the bank sector's transformation and growth? Over the next 3.5 hours, we'll try to answer some of these questions as we hear from leading voices in policy, banking, and funds management. We're particularly honoured to have with us today Shaktikanta Das, Governor of the Reserve Bank of India, and Uday Kotak, CEO of Kotak Mahindra Bank. They will be keynotes in conversation with FT and Indian Express journalists. We'll also hear from Anita George, Executive Vice President and Deputy Head of CDPQ, the Canadian Pension Fund, with more than $300 billion under management. And also joining us is Jaspal Bindra, Chairman of Centrum, who many of you will also know from his former role as Head of Standard Chartered Bank here in Asia Pacific. The event will close with an exclusive fireside chat on the future of finance with Nick Shalek, General Partner of Ribbit Capital, one of the most aggressive global investors in fintech today. Our last event in this series will focus on technology and the green economy, and that will be held on the 23rd of November, co-organised by FT Live, the FT's events division, and the Indian Express. So please mark your diary. This partnership with the Indian Express is the first step in a series of fresh initiatives in India. We're examining new ways of reaching audiences there, and we hope to be able to elaborate on that before the year end. Now, without further ado, it's my great pleasure to hand over to George Vargas, Group CEO of Indian Express, for his opening remarks. I hope you enjoy what promises to be a vital and fascinating discussion.
Thank you, Angela Mackin. You are spot on. This evening's event, the third in our partnership of ideas, couldn't be more timely and insightful for readers and audiences of the Indian Express and Financial Times. There's nothing more exciting than the privilege of witnessing and trying to understand change from the vantage of our respective newsrooms. By being in the right place at the right time, and most importantly, with the right people. So here we are, 2 days before the 20th anniversary of 9/11, the last US soldier having boarded the last C-17 transport plane out of Kabul, a new power calculus emerging in the region, our stock markets on fire, and more than half of the adult population in India having got their first dose of the COVID vaccine. Things were a little different when we began this journey in April. We were right in the middle of the brutal second wave. India's Finance Minister Nirmala Sitharaman was a guest then, and she told us how our immediate task was to get oxygen and ICU beds. Yet, she underlined that the fundamentals of the economy were strong and the reform focus would continue. Indeed, since then, India did away with retrospective taxation, an irritant that had almost for a decade left many global investors wary about policy certainty. Vaccination has picked up pace. Schools and colleges are reopening. The first quarter GDP growth almost by 20%, though on a lower base. These have set the event for today's event, in which we try to understand the trajectory of this rapid change in India, guided by two crucial engines of recovery post-pandemic: banking and finance and capital markets. Launching today's session is an interview with a stakeholder whose each and every word and every action is watched closely by financial markets, RBI Governor Shaktikanta Das. Dr. Das straddles an incredible range from being a magistrate in a rural district in the state of Tamil Nadu to piloting the state's AIDS control mission to a secretary at the center in the critical departments of revenue, finance, economic affairs, and fertilizers. The Das interview will be followed by a panel discussion on banking as a growth booster, an interview with Uday Kotak, the CEO of one of the fastest growing private banks in our country, a discussion on can the market support a recovery by helping the private sector. Wrapping up will be a conversation with Nick Shalek, a global fintech investor with significant exposure to India and one of the best futurists in finance today. That's a formidable lineup, so let me get out of the way and hand over to my colleague P. Vaidyanathan Iyer, Executive Editor, National Affairs of the Indian Express, and Ami Kazmin, FT South Asia Bureau Chief, for the interview with Governor Das. Over to you, Vaidya and Amy. A very warm welcome, Governor Das, and thank you for your time.
Two, one.
Good afternoon, everybody, and good morning to those of you who are joining us from other locations. I'm Amy Kazmin, the South Asia Bureau Chief of the Financial Times, and I'm pleased to welcome you to this session on India banking and finance. Obviously, India's financial system and its health is at the core of India's aspirations for an economic recovery and faster growth. And we're very fortunate today to have the Governor of the Reserve Bank of India, Shaktikanta Das, to speak with us about some of these issues. Mr. Das needs very little introduction. He's had top roles in the Indian Finance Ministry before becoming the central bank governor. As we go along today, I'd like to encourage you to place your questions for Mr. Das in the chat box. We will try to go to a live audience Q&A towards the end of our discussion. You're also welcome to tweet about this session. Please use the hashtag India in the World. I now hand over to my colleague, Vaidyanathan Iyer, the executive editor of the Indian Express for National Affairs, who will ask Mr. Das the first question.
Welcome, everybody. Good evening, Governor. We have the last financial year, we saw a massive shock to consumer demand. We saw a GDP contraction of 7.3% in 2021. But as soon as the year ended, we were in for a bigger shock, which was a brutal second wave of the pandemic. We saw loss of jobs, loss of income. People even had to pawn their gold to meet their daily expenses or their medical expenses as well. Just 7 months back or 8 months back, you talked about the winter of discontentment will be made into a glorious summer sooner than later. Now, since January till September now, how do you look at the prospects of the Indian economy, of the recovery? Do you think that we're going to feel the chills for some more time?
Thank you, Vedyanathan, and thank you, Amy, for having me here. And a very warm good afternoon, good evening, or good morning to all your viewers. Now, you are absolutely right. I mean, during the April monetary policy meeting, which was held, I think, on the 4th or 5th of April, I did say that the economy will now move only in one direction and it will move upwards. And that time, of course, we had qualified by saying that qualified my statement by saying that we have not factored in a resurgence of a new wave of the pandemic, or coming in of new mutants or variations of the COVID virus. Now, we said it on the basis of the fact that the first quarter growth of this calendar year, that is Q4 of last financial year, in other words, the January to March quarter, our growth was positive, in the positive territory, and it was looking good. All the indicators of growth were looking very optimistic. Then, of course, from somewhere in the middle of middle of April, the next second wave set in, and it became very severe and quite widespread in India. So from about middle of October, from the middle of April to, let's say, the end of May, it persisted. So therefore, this caused a big dent on the growth. Now, the first quarter growth numbers have come in line with our projections. That is from April to June, which broadly covers the the impact of which bore the direct and immediate impact of the pandemic. That is already factored in into the first quarter growth. Lingering effects of the second wave, of course, did continue into July and a little bit into August. Now, going forward, how we see the growth? Yes, the fast-moving indicators, are looking quite. Many of the fast-moving indicators, not all, many of the fast-moving indicators are looking quite upbeat. We track about 100 odd, fast-moving indicators, and I can mention some of them, like for example, the sale of two-wheeler vehicles, the sale of passenger cars, or the steel and cement production and consumption, the GST e-way bills, the electricity consumption, the tractor sales, and there are several parameters, and several of these fast-moving indicators are looking up. So therefore, at this point of time, our projection of 9.5% growth for this financial year stands, and I think it will hold good. The second quarter of the current year, that is the current quarter, will do better sequentially than the previous quarter, but there is a base effect of last year which will have its impact throughout this year, but the base effect will gradually moderate going forward. So we are quite optimistic, and quite at this point of time we are quite optimistic about the 9.5% growth which we have projected for the current year. Having said that, I must say that uncertainty of a possible third wave, which people are talking about, that uncertainty still remains. But just half a minute more, I think people and businesses are now more adapted to the COVID protocols and more adapted to continuing with their activities, business activities and other activities, even when there is a COVID. But again, everything depends on the severity and the spread of a third wave of the pandemic, should it happen.
Governor, ever since the pandemic began, the RBI has really been very, very supportive and accommodative in its monetary policy. There was a lot of increased liquidity. There was loan forbearance for MSEs, small and medium enterprises, and generally interest rates have been held low. But with inflation getting close to 6%, I'm wondering if you feel that there's still space to continue with these accommodative policies. Is there a concern that inflation is beginning to become generalized in the economy? And is it time for tightening? And I wonder if you also feel that the government has space for more fiscal measures to support the recovery and ensure that it doesn't lose momentum.
Okay, on the fiscal space part, I would like to say that right from the beginning of the pandemic, the government has been taking calibrated measures, targeted measures. And from time to time, whenever we have any suggestions with regard to further fiscal measures or fiscal support to particular sectors or particular subsectors, we do internally flag them to the government, and the government takes them into consideration, and whatever possible, the government does it, given their financial, their fiscal deficit constraints. So therefore, whether the government has further room or not, I will not give a a straightforward answer of a yes or no. I would only like to say that we do communicate it internally to the government from time to time, and that practice still continues. Now, coming to the issue of inflation, you said that the inflation is sort of remaining around 6%. Is it a matter of concern? As I have said, and as the MPC statement, the last MPC statement says, and as I have also said in my own statement, that the current inflation is mainly driven by supply side factors, partly because of international factors built around high commodity prices, the high shipping charges, the container costs, and mostly international commodity prices going up. That is feeding into domestic inflation. And domestic factors, yes, the high pump prices of petrol and diesel, and also certain commodities, certain items like the pulses or the edible oil. Now this is one area again where we are constantly engaged with the government on pulses and on edible oil. Government has taken certain measures, and they have had their effect. So with regard to inflation, we monitor the situation very closely, and let me make it very clear that the RBI is an inflation targeting organization, but in the pandemic times we have decided to focus on growth, more emphasis on growth, because if the growth completely gets decimated, then it will pose huge long-term challenges for the economy to revive. So during the pandemic, therefore, instead of the exact target of 4%, the MPC has decided to operate within the band of 2 to 6%. So at the moment, it looks that the inflation, which exceeded 6% for a couple of months, they have now moderated to 5.6% in the last print which came out. The next print is due next week. And our expectation is that from now on, the inflation will gradually moderate. So the possibility of a sustained increase in inflation beyond 6% is highly unlikely at this point of time. But nonetheless, we are watchful. We are very serious about anchoring inflation expectations and anchoring the inflation around the target of 4% going forward. And we remain committed to anchor that. We remain committed to achieve that over a period of time in a very non-disruptive manner.
Governor, if I may just, as a sequence to what Amy said, and you told us about anchoring inflation expectations, do you think that, given that you don't really expect inflation to be at sustained 6% levels or higher than that, do you think that you can continue with the accommodative stance for pushing growth? And also, does the worry that increased money supply is feeding some other asset bubbles, like you have earlier also talked about stock markets at at levels which are kind of very high. Does that worry you?
You see, with regard to, I think you asked two parts of the question. Second part is with regard to whether it is feeding into inflation, and the first part, I think you mentioned about the whether inflation sort of. I think you said whether the inflation is exceeding. What was that point? Can you just repeat?
Whether given that you don't expect inflation to go over 6% on a sustained manner, does that give you enough space for continuing with the monetary accommodative stance here?
Correct. Now we had adopted the accommodative stance even before the pandemic set in. Sometime in 2019, we had the MPC had decided and adopted the accommodative policy stance. And we had started a cycle of rate cuts in February 2019. But if I remember correctly, in December monetary policy, and again followed by that in February 2020 monetary policy, the MPC decided to pause with regard to the rate cut cycle. So there was a pause in December of 2019, and there was a pause in February 2020. So India's growth had moderated. So MPC had responded to that challenge, and that time the inflation was well around, within 4% and around 4%. But once the pandemic set in, I'm just, just putting it, repeating it because it explains things in a perspective. Once the pandemic set in, we went for about 115 basis points. First 75 basis points cut, then we did a 40 basis point rate cut. Now, whether we will continue with the accommodative stance and we will sort of look at the rates, etc., that is a decision which the MPC will take. But nonetheless, my assessment and our assessment in the RBI is that, or the way we look at the things, it is as follows. Number one, we are very closely watchful of inflation, and this deviation from, this sort of not deviation, but operating within the, within the band, that was a specific need of the COVID times. We are watchful of the growth impulses becoming sustained, the growth impulses taking deeper roots. We are watchful of the inflation dynamics and the inflation curve, which is expected now to moderate. And as I said earlier, going forward, we will definitely sort of, our effort, being an inflation targeting organization, institution, our effort would be to gradually move to 4% over a period of time. But that timing has to be decided. Today is not the time, and we will take a call depending on the incoming numbers. With regard to high liquidity position, let me tell you that the current inflation, as I said, is driven mainly by supply side factors. And at the moment, there is no evidence to show that the high liquidity is feeding into general prices. Number one. Number two, there is also there is some, yes, global liquidity is not only surplus in India. Globally, central banks have infused a lot of liquidity. So globally, there is a surplus liquidity, and the stock prices are very high and are booming in almost every market, including India. But there is no evidence, and to some extent, the current high stock prices in India have been influenced by the excess liquidity. But second point which I wanted to mention is that there is no evidence of high asset prices, namely the high stock prices, feeding into general inflation or general prices. So therefore, high inflation getting generalized, we do not anticipate that kind of a scenario to occur.
Governor, I'd like to, if I may, turn to the banking sector. Even before the pandemic, the banking sector had been wrestling with high levels of bad loans and had been struggling, although there had been a lot of progress made on trying to resolve the bad debt burden. How much of a setback has the COVID pandemic been in terms of a new wave of bad loans? And what are you seeing in terms of the stress on banks' balance sheets?
It's in the last financial stability report, we have given a baseline scenario, and we have given a scenario of severe stress. Even under a severe stress scenario, our, the GNPA, the gross non-performing assets, we have projected at 11.2%, 11.22% to be precise. And the resolution packages which we announced last year in August and again this year in May, especially for small and medium businesses, for the MSMEs. This time, the resolution packages are not open-ended. They have a starting date, they have a completion date, and a time limit is set within which the restructuring of the loan portfolio has to be done. We have also insisted that while doing a restructuring of a particular portfolio, the banks will have to make provision. Simultaneously, they have to make about a 10% provision in their, in their books for all those restructured assets. So therefore, and that will act as a buffer in the event if a particular restructured asset falls by the wayside, or if it has develops further stress. As the numbers, according to the numbers which we have currently, the NPA levels look quite manageable. And for example, the last data at the end of February, which we at the end of June, for the banking sector, it's about 7.5% GNPA, and for the NBFC sector, it's a little less than that. And the capital app, the CRAR as we call it, capital to risk weighted asset ratio, that one CRAR for scheduled commercial banks overall at the aggregate level is at about 16%, and NBFCs is about 25%. And the other thing we did last year and even now is that we have impressed upon the banks and nudged them to raise additional capital proactively in anticipation of some stress which may arise. And I'm happy to note that most of the banks, including private and public sector banks, have mobilized additional capital, which should stand to their defense if there is an increase in the stressed assets. But as I have said, at the moment, the situation on the front of stressed assets look well within manageable limits.
Yeah. Governor, one of the things which has been, bothering some in the markets is about this, banks taking huge haircuts in terms of, when it comes to resolutions of big defaulters, as high as even 90% at times. At the end of the day, it is all depositors' money. What has been, does that concern you? What has been your conversation with banks on this? Are there any lessons for that the RBI would take as we move forward in the insolvency part?
You see, first thing about this this IBC, the Insolvency and Bankruptcy Code, that the measure of success of IBC is not what percentage of recovery takes place. Yes, it is an important factor, but the primary objective of IBC is resolution of bad assets to wherever possible to resolve the business so that the company or the business continues its operations, and the economic value which that business creates, that continues unabated. The intention is that if the functioning of a business or a company continues, jobs are also protected. So the business continues, economic activity continues, and jobs also remain protected. The idea is not to allow, if it is possible and if it is viable. Of course, if a business is not viable, then of course it has to be a different route. Now, that is the first aspect, that the effort is to see that the business continues, the activities continue. The second, coming to the recovery percentages which you have mentioned, the average recovery under the Insolvency and Bankruptcy Code is was about 45% for the previous 4 or 5 years. It came down to 40%. I'm talking about average at the aggregate level.
Average.
For all the yeah, it's 40%. Taking into account the pandemic year. Now, yes, some cases the haircut has been 90%, but there are cases where the haircut has been much less. And with regard to the further improvement of the IBC framework, we have, yes, I agree that there is scope for improvement in the, there is scope for improvement in the functioning of the IBC and in the framework. There is perhaps need for certain legislative amendments also. We have some suggestions which we have flagged to government. For example, the process of the time taken to admit a case to the NCLT, the admission itself takes a lot of time. So can we deal with that issue through some legal amendments? The IBBI has also come out with a governance document with regard to the functioning, on the various issues. So that also we are examining. So there is scope for some improvement, and the time taken in the whole process, I entirely agree, needs to be reduced by simplifying certain procedures and wherever necessary by carrying out legislative changes.
We're starting to run out of time. I'd like to put a couple of the audience questions to you. Number one, I'd like to ask, why is credit growth being so slow to pick up? Is it that demand is slack due to low prospects, or are banks cherry picking customers because they're reluctant to lend?
You see, what is happening is that for the regulator, we have to provide an enabling ecosystem where the banks are in a position with adequate capital and with adequate resource, with adequate liquidity and capital to give loans. Beyond that, it is a function of the market. Now, why the offtake has been low? I would feel that it is primarily because two factors are important. Primarily because of the uncertainty which still prevails with regard to the COVID pandemic, and with regard to the what kind of impact it will have on the economy, and whether the markets, the revival of activity will be sustained and will be I think there is still some uncertainty in the minds of the business, especially emanating from the pandemic's the future curve of the pandemic. So that uncertainty continues. The second thing is that during the last 1 year, because of the liquidity which we have provided, many medium and large businesses, they have deleveraged considerably, and they have enough space in their balance sheet to invest. Perhaps they will invest when the time comes. The third point I would like to mention is that what you call the I think there are investment plans, and it should be, there is still a lot of slack in capacity utilization. The current capacity utilization in factories is still way below, it's still falling short of the pre-pandemic levels. There is a slack in the demand, there is an output gap, and there is the aggregate demand is also below the pre-pandemic level. So therefore, I think there is a lot of wait and watch which is going on. Once the business gains confidence that the economic improvement, that the GDP restoration or the revival of activity will sustain, I think that should be a point where there will be investment and will lead to a demand for credit. The latest number which has come out is about 6.77% year-on-year growth with regard to bank credit, which is marginally higher than the previous number, which was published by the RBI.
Oh, I'm very tempted. There's one more question that is on a lot of people's minds. If in a very short answer, can you tell us your thoughts? Should India adopt cryptocurrency? Or
we have conveyed our serious and major concerns. We have conveyed our major concerns to the government about cryptocurrencies. Serious concerns, major concerns from the point of view of financial stability. Government will take a decision, and I think we need more credible answers as to whether going forward the whole private cryptocurrencies, what contribution it will make to Indian economy going forward. I think we need more. We need to be convinced more with more credible explanations and answers, and so therefore that is how I would like to explain our position, and it's now for the government to really take a decision in the matter.
I'm afraid we're out of time, so I'll hand over to Vedi.
Yeah. Thank you so much, Governor. We have really run out of time, and the questions won't stop coming in. Thank you, Governor Shaktikanta Das, and thanks, Amy Kazmin, for co-hosting this interview with me. I would also like to remind the audience that this session video would be available on demand for at least 30 days on our Vivint website. In a short while, in a few minutes from now, You'll all be joined by my senior colleague, Sandeep Singh, who's associate editor with the Indian Express. He will moderate the first panel on India's banking system.
Good afternoon, everyone, and welcome to this panel discussion on India's banks. Will the latest reforms boost growth? Well, banks are the bedrock of the economy, and a successful economy must have a strong and well-regulated banking sector. Over the last couple of years, government has undertaken various reforms in the banking space, be it merger of state-owned banks, initiating setting up of a bad bank, and then the decision to privatize, starting with two banks this year. While the economy is slowly coming out of the pandemic and can be seen on various fronts, banking sector continues to face various challenges. Today, we will seek answers from our esteemed panelists on the challenges for banking sector and how they see growth for banks and the economy. Let me quickly take you through our panelists, speakers. First, we have Ms. Ashu Suyash. Ashu is the Managing Director and CEO of CRISIL. She has worked with the Indian financial services sector for almost 33 years. Before joining CRISIL, she was the CEO of L&T Investment Management and L&T Capital Markets, and she also led Fidelity's India mutual fund business earlier. She has also spent over 15 years at Citibank. Now, we also have Mr. V. Vaidyanathan, Managing Director and CEO of IDFC First Bank. Mr. Vaidyanathan has worked with Citibank, and then he set up ICICI Bank's retail banking business between 2000 and 2009. He then moved out and acquired Capital First NBFC and later merged it with IDFC Bank in 2018. Mr. Vaidyanathan is seen as a risk taker. From being at a leadership position in ICICI Group, he moved out to become an entrepreneur. However, now he is back again as a banker. Mr. Jaspal Bindra, he's the chairman of Centrum Group. Mr. Bindra is a seasoned banker and global MNC career of over 30 years. He was the Asia Pacific head of Standard Chartered Bank and has also worked with Bank of America and UBS. RBI recently granted small finance bank license to Centrum Financial Services, and it will take over PMC banks. So he's also with us. Now, before I start, I would like to tell our audience that they can ask their questions at any time through the Q&A box to the right of the screen. We'll try to answer as many as we can in the last 10 minutes of the discussion. You can also share your thoughts and tweets on social media using hashtag India in the World. Now, to start the discussion, I'll first start with the challenges that the banking sector is kind of engulfed with. I'll ask Ms. Suyash first. She's watching the industry closely. she does the rating of the companies and sees how they're performing. Now we are witnessing a growth on various fronts, as can be seen in mobility indicators, GST collections, etc. However, credit growth remains a big issue for the economy and more so for banks. There seems to be a situation where banks are not comfortable lending to those who need money. How do you see the situation? What is leading to this slow credit growth?
So, we've always seen credit growth tracking nominal economic growth. And by that token, last year, we should have seen credit degrowth, but that didn't happen. Overall, we did see credit growth in the region of 5 to 6%, while the economy degrew 7 to 8%. And that in a way raises a lot of questions. We do talk about credit growth not being there, and that's because we saw degrowth in the first half of fiscal 21, and then as the economy started recovering, credit growth did come back. What really led credit growth last fiscal was a strong agri economy, a strong rural economy, because we had good monsoons and there were some very good supportive programs as well. In fact, that helped the overall economy. Also, the emergency credit line given by the government for the MSMEs meant that the MSME and the SMEs saw growth, and retail even last year grew between 10 to 11%. The challenge was corporate credit growth, which also wasn't degrowth, but probably 0.8%. And this time, the second wave was far more severe, but we did not have as stringent a lockdown as we did last year. And so, even the first half of this fiscal is likely to see a better year on year growth. And again, we expect to see agris continuing to grow in the 10 to 11%. Retail, in fact, and my co-panelists will have a lot more to say there. We actually are expecting retail credit growth to get to the mid-teens, which is really tracking maybe the past couple of years average. So it's a strong indicator that slowly confidence and consumption is coming back. And
Okay.
we're beginning to see that movement even in the home loan segment, which happens to be a very strong indicator there. And our expectation is that even corporate credit growth this fiscal should be in the 5 to 6% region. And therefore, overall, we're expecting banking credit growth to be in the region of 8-9%. So that's
Okay.
not
So,
something in a bad place at all. The whole point is, how does this compare to, let's say, the last 5 year average? And
yeah.
is it something that is good enough to power the economy and really lead to very strong economic growth? And that is
Right.
where perhaps more lending, especially to the mid market, which does not receive adequate credit. And if you look at the numbers beyond what comes under the credit guarantee scheme, is not as much. In fact, the CGT SME scheme has not seen much of an offtake. So that's a good pointer in terms of perhaps where are the areas banks might focus on, and also how banks and non-banks can partner better, and how a co-lending model can
Yeah.
really continue to power economic growth.
Right. Mr. Bindra, I'll like to have your view on how do you see demand? Is there's enough demand in the market? Uh, uh, because at this time we are seeing a lot of customers deleveraging, raising money from equity and outside. Do you think bank need to rework their strategy? How do you see that? I mean, the demand and basically restructuring. Reworking their strategy. How do you see? Mr. Mitra, could you hear?
Yes, no, I heard you. So I feel that, if you take into account some of the things Ashu said in terms of the rural spending schemes that the government has put a huge thrust on, also
Yeah.
the bounce back in the commodities sector, which has given a huge fillip to that sector from a credit point of view as well. Um, the credit growth, if you exclude those and a good monsoon, etc., then the credit growth could have been much larger. If in a normal year we had that, but we have to assume this is a black swan event, and there will be some impact on the credit growth. So I think the way I would see credit disbursement is clearly from the borrower's point of view. There is something left to be desired, even in spite of all the MSME schemes and everything else that the government has spent on. But from the bank's point of view, it's probably seen as prudence, because Ashu herself will be the first one to derate the banks if they went aggressive in this period, because she will say, the environment doesn't justify aggressive lending. So we will have to. So I think you'll have to look at it with a balanced view. I think the banks have done what they think is right. The one area where I felt there could have been more encouragement was through the IBC process, but that has been rather slow. Having said that, I'm saying it's something that is in the right direction. We need the IBC to be much more a robust process, but so far it has still been slow. That could have helped more, but I think that is to be seen.
Yeah. Yeah. Okay, Mr. Vaidyanathan, now while Ashu and Mr. Bindra said that, okay, there is some growth, but maybe that is not enough. Uh, India is hobbled with NPAs. I mean, if a big portion of country's loan book is stuck around 10 to 12 lakh crore, I mean, how can the industry kind of sprint with its hands tied. How do you see? I mean, is that something that is tying them up, and the past experiences, is it has it scarred the sort of the risk taking ability? How do you see that?
See, if you go back just a few years, let me say 2015 or 16, when AQR was done, asset quality review by RBI, you found that lots of banks had lots of NPAs, but there's a very big difference between that time and today, just in 5 years or 6 years. Big difference. Big difference is during this period, almost all banks have recognized the issues, if required, charged them to the P&L, raised fresh equity, and I would say, like, a pandemic has come and gone, and a fire rages through a forest and fresh grass reappears. It's almost that sort of a cleanup that has happened in the banking system. So in the sense, if you think about it, I think private sector banks have raised not less than about 1.2, 1.3 lakh crores of equity during the last 18 months. Even state-owned banks, if you remember, so many banks were in PCR until just about 3 years ago. Almost many of them have come out. In fact, state-owned banks have probably got about 2.3 lakh crores from the government. So that kind of equity has got infused. And therefore, I would say the banking system is a much stronger situation at this point of time, even compared to the pre-pandemic.
Okay. So how do you all? All three of you. I mean, I'd like to one by one, if you can go. But the biggest issue, I mean, what is it that really concerns you? Is job creation in the economy a big issue? And do you see it somewhere linked with the overall growth of the economy and the banking sector? How would you? Because that is something that still the economy is grappling with. I mean, while we are coming out of the pandemic, jobs have been a big issue. I mean, if you can speak, I mean, Mr. Vaidyanathan and then Ms. Shreyas and Mr. Bindra. Yeah.
See, I'd say that, of course, during pandemic, a lot of, as you know, India has a large number of informal jobs, and definitely they got impacted during the pandemic. But of late, the kind of jobs coming up are a good number of gig economy jobs are coming up, because there are jobs in e-com, delivery, logistics, healthcare. With the kind of companies like Uber, Ola, and Swiggy, and all that. So you find just a large number of gig economy jobs coming up in the country, which is a very big trend. And frankly, the last number I read was that gig economy jobs in India was growing by between 26 to 30% a year on year for the last 2 years. So that's one big thing. The second thing is the kind of jobs that's coming up in this sector. Of course, the traditional jobs like sales, marketing, etc., they do come up, and as the economy grows, the traditional jobs grow. But the new jobs are like the ones that are more in the AI economy, data economy, cloud economy, product development, API factory and API economy, API jobs. So those kind of new economy jobs, robotics, AR, VR. So all the new economy that's coming about, is just like crazy number of jobs getting created there. So I think those are high-skilled jobs, high-paying jobs, higher value-adding jobs, and in that sense, it's great for the Indian economy as well. So when you think about it, traditional jobs will grow, and the economy will grow in a bit more in a secular manner, in a proportionate. But this one is a big one, and I think we should be optimistic on this front.
Okay. Ms. Suyash, how do you see that? Will help the kind of. Are you satisfied with the job creation in the economy? I mean, the way at the pace that it is growing, and how will it augur growth both for banking and India?
So, a couple of points that come to my mind. One, we went into the pandemic on a weak demand base because consumption was slowing, and for India, it's the biggest engine of growth has been consumption. And we know that it's consumption that crowds in private capital, because you end up hitting peak capacity levels, and then new investment capacity comes up. If I think about what happened last year, it pushed out the investment cycle, I would say, from anywhere between 18 months to 2 years. So it's unlikely that we are going to see an investment uptick coming. Consumption, demand, and employment is very closely linked. The reality is, with the havoc the pandemic created, because was a human crisis, it is a human crisis because it's not yet over. Uh, the contact based industries, which are very large employers of people, have not yet come back on the growth path, which means you have that very large workforce that is either unemployed or only partially employed, whose wages and lifestyle and livelihood has been very sharply impacted. On the other hand, in the process of coping with what the pandemic brought upon all of us, clearly tech digital is roaring. And if I look at attrition levels in the industry, it's crazy. And it's not just a India phenomena, but frankly, a global phenomena. If one looks at the number of graduates coming and the demand of where the jobs are and where the graduates are coming from, there is a mismatch. And that is what uh, is a worry, because we need very strong upskilling, cross skilling, and a change in the mindset. I think, Mr. Vaidyanathan brought up a very good point on the gig economy. As Indians, gig economy is not something people are comfortable with. Part-time employment is a huge worry for families. And if you ask me, that is what is impacting confidence and consumption patterns. And this really needs to change. And it has to be a partnership between the government and the private sector and the education institutions to really prepare India for the next lot of jobs that are going to come up, because a lot is going to be automation led. Even factories started becoming hugely automated across sectors, right? And that's going to hurt employment in a traditional sense. So that is, I think, what bothers us, and that is what we look at very closely when we look at forecasts for the medium term. And that's part of the reason our forecasts say that there is a permanent loss in GDP to the tune of 100 to 125 basis points. That's not even going to come within the next 3 years. And this explains why.
Yeah, right. Mr. Bindra, when do you see the investment cycle now? Okay, gig economy is there, it's working, but banks, I mean, the retail is also there, but big banking sort of business is on the corporate lending side. When do you see investments coming back? Are the capacity utilization levels rising? And which sectors do you see leading that path, sir? Yeah.
So I feel if we look beyond the immediate, I would agree with everything that Mr. Vaidyanathan and Ashu said about where things stand today. There are some good patches and there are some difficult patches, but there's also a scar that has been left by the pandemic, which will take some time to recover from. But if you look at just a little bit beyond the immediate, the per capita income is now close to $2,000 for an average on the current terms. We have seen this around the world, that as it goes above the 2,000, 2,500 mark, there is a disproportionate consumption spend. Now, because of everything Ashu said, that move from just below 2,000, 2,500 may take a little longer had the pandemic not been there. It would have been quicker. But nevertheless, I think directionally we are moving in that direction. So I think we will see not a linear curve. I think we'll see a very steep curve after maybe a stagnant or a flattish period, maybe another 18 whatever months. The second thing is that the FDI inflow of foreign capital is just so huge that is going to come into the system. That is new capital. That is complete aid. In fact, that in itself will be a big spur. And if the government lives up to its promise in the budget of spending, to its asset monetization plan, to its
Yeah.
spend on infrastructure, to its privatization of some very key sectors, then I think there's going to be a huge inflow of money into the system. And I think, as far more well articulated by Ashu, I mean, that itself will spur the growth and the consumption pattern in India, which will lead to growth. And banks are actually a corollary. I mean, hopefully Mr. Vaidyanathan will bear me out on this. I mean, the growth of the bank is directly correlated to the growth of the economy. I mean,
Yeah.
if the economy is not growing and you are counted as a growing bank, then there is a problem with your bank. So it has to be together. Then it's a matter of
Yeah.
degree. Some people do it better and more efficiently.
Yeah. Yeah. So, Mr. Vaidyanathan, that brings me to you. I mean, what are you betting on? I mean, what are the new emerging business opportunities? Where are you going to? Where do you see lending? I mean, happening or growth coming for you? Digitization is coming as a big wave across the country. Also, if you can give me an example, take me through how things are changing and how banks are touching entrepreneurs' life, because that is a big segment. So many startups coming up on a daily basis. Yeah. So where is the growth coming for you?
No, I first of all agree with what Mr. Vendra was talking about. See, the thing is that when you see the economy as is coming up in front of us, there are some big things and big changes we are seeing. All of us know that the big ecosystem opening up was first. It started with the the Jandhan Aadhaar mobile combination, and that was a big one. But then on top of that combination, the credit bureaus became very effective. And on top of credit bureaus, now we have the NPCI, which is the UPI based. And you got UPI that became so successful. Last we heard was like close to 6 lakh crores got done last month. Then on top of this, now we have the account aggregator system that's coming about, where all banks, all transactions, all customers can come in a single readable format and go to the service provider who can provide solutions. So if you think about it, this digital ecosystem is evolving so very fast, and is really making a lot of things that was just not possible earlier possible today. So basically, if you were to ask me, how do I look at this ecosystem? I'm very much thrilled by this ecosystem that's emerging like this. I feel it is throwing up enormous opportunities, and we can do lots of things. The customers whom we could not fund before, you can fund today. The gig economy, you could never finance earlier. Now we can finance even the gig economy on the basis of their stuff. Small entrepreneurs you could not finance earlier on the basis of paper-based evaluation. Now we can do cash flow-based digitally and all that. So this system is opening up. At the same time, new markets are opening up. Earlier electric vehicles did not exist. Now you see a huge mushroom of electric vehicles coming about. On the back of the electric vehicles, now you will find one huge, cable charging network coming about. So there are like enormous number of new economies coming about, and that is going to be new economy, new digital economy coming about, and a new a normal economy coming up. So they're all combining to become a really big play. Finally, you say that, look, we all know that, we say that there are 110 million employment in the MSME sector. We say that so many times. They never got credit. Now they can all get credit. They can also get probably side insurance. They can also got side mutual fund. So a lot of sectors who never got credit, never got any of those things will get it today. All in the backbone of these stuff. So I'm frankly very excited what's coming up.
Yeah. How do you see that, Mr. Suresh? I mean, where do you see, I mean, banks, because you are looking at the entire set of companies who come to you for rating and all those stuff. I mean, where do you see the pressures are? I mean, in fact, ECLGS, while that has been a credit growth sort of what we can say an island of credit growth over the last 1 year or so. Is there risk building there? I mean, and where do you see growth coming from? I mean, where are banks focusing? Yeah.
So the first thing is that the banking sector has seen tremendous reforms over the last couple of years, and the recapitalization of banks has really put the entire industry in a much stronger place. I doubt if we'd be able to cope with the pandemic had we had the pandemic in 15, 16, the AQB times. I think we would all be sitting in this panel really, clutching at our hair or head. The second is, I think the IBC is a path-breaking reform, because that's really transformed the credit culture. Earlier, the saying was, the borrower took the money, never thought it was their job to return money. That's completely changed, because this is about creditor and control. There are timelines, and frankly, that's really resolved a lot of challenges that banks were saddled with. The third thing is, the national ARC or the bad bank. That's going to free up more bandwidth, more capital, because this is some of the legacy, bad book issues that banks have been saddled with. I think the merger of the public sector banks and creating 4 large banks from 10 has really geared up the lending system for a growing economy. Because end of the day, a growing economy, and if it is about the 5 trillion or it is about financing the big Indian dream, then you need banks of scale, right? And then the recent announcement on privatization of 2 banks clearly communicates that it is about competition, it's around efficiency, and may the best win. That itself creates a very good check and balance in the system. And therefore, the way we're looking at it is that from an issue perspective, I think we cannot wish away that there is credit stress, but some of the measures that were needed, that were taken last year, be it the moratorium or the restructuring scheme or the credit guarantee scheme, has really helped, which is why you didn't see NPAs escalate out of hand. In fact, they were 100 basis lower than fiscal 20. We will see some inching up. We're already seeing some of that stress in the retail space and in the SME space, because that segment can withstand 1 year, but 2 years in a row is tough, right? It really hurts cash flow. But I must say that it's nowhere close to raising alarm bells. In fact, forget NPAs. If you look at stressed assets, right? The restructuring book plus NPAs, our estimate is it's still under 10%, which is lower than what we would have seen from an NPA number perspective in 2018. And there are 2 very material reasons for this. One, the previous NPA problem was a large company problem. And over the last couple of years, active deleveraging, active raising of equity, and of course, the uplift from better commodity prices and, lot of other policy initiatives that were taken, even in the infrastructure side, really helped. So that, I think, is a big positive. On the other hand, this time round, it's the mid-market and the SMEs that have got hurt. The real challenge is, as growth comes back and all these dispensations, all these schemes run away, then what? Then it's down to banking 101, right? It's about robust credit processes, it's about great collection mechanisms, strong MIS, strong management of capital, having adequate capital buffers, and definitely provisioning. And the system as a whole is reasonably well provisioned. So in that sense, I would say it is about wait and watch. And if you think about it, if you don't see that uplift coming from credit, then we frankly have a bigger issue, because you will have more challenges than less. So that, I think, is the way we're looking at the banking system. One last point I would make, and this often doesn't get discussed enough. It's important to discuss financial system, which is banks and non-banks, because the non-banks are no longer a small part of the whole ecosystem. So that better partnership, I think, can work, and co-lending, co-origination, which we started seeing. I think it took a little bit of a backseat during the pandemic. Opportunity for it to come back, and definitely strong partnerships with fintech and financing. The infrastructure side needs the new DFI, I think, to come up sooner than later.
Okay. On the fintech aspect, now I come to you, Mr. Bindra. How do you see them? I mean, do you see them complementing banks? And how sustainable is their business model in terms of profitability and all? How do you overall see the fintech's role in the overall credit growth and banking and their collaboration? I mean, do you see as a competition or as a complementing to the banking industry?
So I feel that the fintech's time has come. And just like we saw in the last 2 decades, how NBFCs became an extension or an arm of banks, we are probably going to see many degrees of collaboration between banks and fintechs. I think the big difference in the fintech world in India versus the rest of the world is going to be elsewhere. If you look at the US or the European market, etc., the fintechs are trying to disrupt the banks. And to some extent, that is more possible there because the interest rates are so low that the cost differential of funding is 1 or 2% between a fintech's cost and a bank's cost. In India, for the best fintech, the cost is 6 or 8% more than it will be of a bank. So I think disruption potential is very limited, but the collaboration potential is for the banks or the fintechs to give up. I mean, I think there's phenomenal. The scale, the speed, the reach that fintechs can bring is just going to be not as easily possible if you don't collaborate. But the cost that the bank can provide them, and the brick and mortar actually for secured products, etc., is also going to be a big plus that the banks can provide. So I foresee that there's going to be an era of very strong collaboration, and I think we're seeing the first few of those beginning to happen. So banks will embrace technology, but fintechs as well very strongly, and I think the fintechs will not survive if they try to compete with the bank. They will have to work with the bank.
Okay. Mr. Vaidyanathan, you have bet your career on financing small entrepreneurs and retail borrowers. I mean, what are the upcoming retail business opportunities? Where do you see that coming in? Are we able to see some zones where there is a big growth that is there? How do you see that? Yeah.
See, like the speaker spoke earlier, there is a rapid change in the ecosystem of being able to reach these segments. Earlier, you had to take the paper and evaluate their income tax return, and frankly, 99% of them don't file tax returns. You can never lend to them, and then even if you lend to them, it would be inefficient way, credit loss would be high, and all that. That era is changing so quickly, you can't believe. Now, specifically now, cash flow assessment, everybody knows is the right way to go. But then now being able to do digitally evaluate cash flow, that through in an aggregated manner across so many banks is a big breakthrough. So you're right. I mean, I've focused on this business for forever and ever, and I really like this piece. I must tell you one quick story that when we started our earlier company, Capital First, we were borrowing at anywhere between 13 to 14%. So if you borrow at 14%, and that's a starting base, and banks were borrowing at probably at 4% or so. So how do you lend and how to make a profitable living? So we should lend at 26%. So how do you lend at 26%? You lend to these entrepreneurs and start like that. But that rates have come down, like to like over the last few years sharply because the transaction cost has come down. So I see really a big game here on the because of our ability to reach them. Second thing is the size. Now you can do really small ticket sizes. You can finance somebody through buy now, pay later model for you can finance somebody for 500 rupees or 300 rupees for buying a small, an item. Now, these kind of things you could not finance. How could you finance somebody for 300 rupees earlier? It's not possible. So sizes have come down, interest rates have come down, reach has gone up. This technology has done some amazing things.
Right. How large is this Indian credit market on the retail and consumption side? How big is the?
It's pretty large, in absolute terms. Let me just say that close to about 28 to 30 lakh crores is the retail lending alone, and then which is the traditional consumption area, homes, cars, etc. All that. By the way, 50% of which is largely home loans. And then over and above that, business lending to small entrepreneurs, which is practically retail. You can give a loan of maybe 1 crore rupees and below. Now that is also a very large market. You can count it something like about 8 or 10 lakh crores. So if you put it all together, it's sitting on a 40 lakh crore market on a 108 lakh crore market. That's like close to. So this is a pretty large market and still so underpenetrated. You won't believe. For example, India's credit to GDP is still 56%. India's retail credit GDP for all the numbers at only 40 lakh crores is still only about 13-14%. So when I said 40, I meant including the individual business loans. So what I'm trying to say is that it's still a long way to go. You and me can't consume it in our lifetime, I can tell you.
Okay, yeah. Mr. Bindra, on reforms aspect, I would like to understand from you. I mean, what can the government do for confidence building for banks to feel comfortable in extending credit? What more is required from them? Yeah, what can the government or the regulator do? Yeah.
So I think let me start by saying that the government has done quite a few things which have gone well so far, but the potential is so much in the economy that they can continue to keep doing that for a long time. And I feel that really, if they just live up to the spending part that they have promised, I think that will go a very long way, especially the spending that goes into infrastructure, because as you build infrastructure, that acts. Now, if you look at, if you were to talk to an economist, he would tell you in a more clear way than I can. But really, if you want growth in the immediate, that is the near to medium term, you need credit flow. And in the longer term, you need productivity growth. Yeah. So I think a lot has to be done to find credit availability to find that growth. And so the reforms have to be directed with credit availability. I think we have a wonderful opportunity given the global scenario to become a more attractive manufacturing destination. And I think the government is probably working on that direction. We were always a good service provider, but I think we have now that opportunity. I think we also have the opportunity, and this may not be so much the government's doing, but I think under the new work culture where there is this working from home model and part-time model, I think there is a great step up on gender equality possible in work environment. If you look at China by having adopted the one-child policy, where every entrepreneur could only have, any rich person could only have one child, many businesses almost automatically got headed by women and not by men because there was only one child in the family. I think by allowing working from home and part-time working, the companies are going to encourage more women to come into the workforce than was possible earlier. And India is a poor, contributor in that. So there's a very large workforce that can become more productive than before. And I think there also, whatever the government can do, that will be very helpful.
Since I have you here, I'll have a quick question from you on the status of, because RBI in June, you got the in-principle approval and 120 days were given to start the operations. I think 90 days have almost gone. Where do we stand now? And also what I mean, there have been some problems with the Equitas and all. I mean, in the small finance bank space. So, how do you see that? Do you see some challenges there?
Well, we are just filing our application with the RBI today.
Okay.
We are inviting ourselves to the problem ground or the zone. But no, I think, as Vedanthan mentioned, the opportunity is so large that you can only spoil the party for yourself. There are very few markets in the world of our size that have an unlimited requirement for credit.
Frankly,
it's
I'd like
not
to
like
come in there.
yes, please.
You can grow this for ever and ever at 25% for a pretty long time. Coming from a small base, just first company is going to come from a small base. We're still about 75,000 crores. We still feel we're coming on a small base. These businesses can grow at 25% for a pretty long time. You see, large banks like HDFC Bank having maybe even a 6 lakh crore or 7 lakh crore retail book is also growing that at 20%. Can you imagine? So, that's why I told you, not in a lifetime we can grow enough. I must tell you a number. In 2010, when our company started, our loan book was $14 million. Okay, it was $4.5 billion in 2018. Today, it is like $10 billion. All in 10 years, and it's still growing. So you can just don't worry about growth. There's enough here.
Okay. So, Mr. Vaidyanathan, then what do you think is needed? What would you need from, or in terms of regulations, or in terms of something more that you think should be done? And a quick response, basically, because we are running out of time. And Mr. Suyash, also your views also on that. I mean, what else is required? Do you need an additional support that you see? Yeah.
No, basically can't call it additional support. Frankly, there's lots coming our way all the time. And frankly, I think our regulatory
some
ecosystem
tweaking that is
India
required, which may be hampering the growth. Sorry,
I'm coming to that. So I'm saying largely in India, I think it's a humming ecosystem. An Indian ecosystem is fast developing. I don't think any ecosystem in the world is, at least in an ecosystem change sense, developing so fast. So at least as far as India is concerned, I think if we can stay on the forefront of regulations, keeping in tune with the technological changes, I think that will be a big deal. And secondly, if the growth, if the growth momentum of the nation is sustained, like I think one of the speakers said earlier, I think Jaspal said earlier that banking is a proxy on the economy also. If the economy keeps growing, humming along at 8%, 9%, I really wish, all things apart, I really wish India sets itself a growth of like 10% per annum as one of the objectives, or 9%, and goes after it year on year for 20 years. And for that will take some doing, not just on any other front, also take some doing on reforms continuously. I'm really looking forward to that.
Yeah, so if I can add, to finance that growth, clearly there's a lot more that needs to happen to deepen the bond markets. We've had deep equity markets, liquid equity markets.
I'm sorry, this is something that, I mean, we hear for the last 2 decades. I mean,
Right.
what's stopping?
So to my mind, the fact that we've remained a AAA, AA market is where the problem is. And one big issue there is, if you look at the longer term debt, it tends to be in the nature of infrastructure financing. And like I said before, the DFI needs to be up and running very fast. But beyond that, allowing our pension funds to be able to invest, across the credit curve, at least investment grade and better, I think is a key important requirement. The securitization market was great, but it just went because of many reasons. So the revival of the securitization and structured finance market is very critical. To my mind, credit enhancement mechanisms, if we could see a emergency credit guarantee scheme for the mid-market, there's no reason why we can't really have credit enhancements or a credit guarantee scheme for the broader marketplace, especially on the infrastructure side. And finally, something that maybe Jaspal, you will recall, India had some form of a secondary loan market that had started in the late 90s. It literally vanished overnight. And I recall, being part of placing some loans, both private sector and public sector. And we talk about a better banking ecosystem, better debt capital market. I think we also need a secondary market for loans. So, to my mind, these need to purposefully happen and in a very defined time frame. Because without investments in infrastructure, I really believe that the great Indian dream will just remain a dream, because consumption and retail will only take us that far.
Yeah. Okay, I'll take a few quick questions from the audience. There's one on, the economics suggests that abolition of income tax to boost the confidence and the buying power of consumers. I mean, is it as good an idea as as people say, or is it mere an ivory tower? I mean, any one of you, if you want to take this up.
Well, abolition of
Mr. Gat-
tax is never a great idea, and in a sense, but low tax rates would probably help. But one suggestion I would have to maybe to add to whatever the gentleman said, I've always been requesting and wishing that the corporate sector has had a progressive tax structure starting with really low rates like 5% or 2% for small entrepreneurs, progressive,
Yeah.
like personal income tax. In that model, according to me, like millions of entrepreneurs will pay 5% or 3%. So maybe I could enter. But otherwise, abolition, I find it's a bit fanciful.
Maybe we are coming that way. September 2019, I think there was a reduction in the rates. But yes, okay.
No,
So
I know.
one more.
The bringing to 25 was fine, but I think large corporates, they can afford to pay 25. I don't think anybody or 22. Nobody should ask for any more benefits now. I think only small entrepreneurs should get benefits. But anyway, I made my point.
Mr. Bindra, there is a question for you. To what extent is the Indian banking system affected by cross-border insolvency? Are there growing risks in that direction? What suggestion would you have on IBC in this regard? A quick one, sir, on this. We are short on time. Yeah.
Yeah, very quickly. I think India's participation in the global supply chain is still finite and limited. I think as that grows, that risk will increase proportionately. But right now, I don't think so. It's a much bigger risk for the US and China because they are very predominant in the global supply chain. Just given that manufacturing exports is not our big forte, I think we have a very limited risk also from that point of view.
Yeah. There's one for you too, Ms. Yash. Do rating agencies and bank auditors conduct forensic accounting and flag potential risks to benefit the shareholders and depositors of the banks in DFC?
So, rating agencies do not conduct forensic audits. That's
Right.
the forte of auditors and requires a very different skill set. For us, it's about honoring data obligations in time. And the focus is really on that. And of course, as part of it, a holistic assessment across management, business, environment, and the risks as we see it is definitely taken into account.
Yeah. I have one additional question on that point, especially. I mean, isn't there an issue? I mean, it's always a criticism that rating agencies also face. I mean, once a default happens, then the downgrade happens, but by the time the system has already felt the kind of impact of that, how do you respond to that?
So that's not true across all rating agencies. CRISIL's own credit default statistics tell a very different story. We've been able to call downgrades, forget defaults, right? So you start downgrading the moment you start seeing deterioration, and it's a pretty robust and long track record. Having said that, there can be some surprises. I mean, fraud, for example, even an auditor is not able to see a fraud, right? And we've had those situations for sure. So I think that's a lens that also needs to be kept in mind.
Yeah. One more I can squeeze in. How is the COVID fueled digital boom going to transform the conventional banking sector in India? We have touched a bit on this, but just to, what are the everlasting changes expected?
Since Jaspal is the senior most, let us give him the privilege of answering the question.
That is among yourselves. You can.
I think the obvious is there already. I think clearly it has changed work culture almost permanently to some extent. I think it has changed the familiarity and comfort with digitization, even in households where we have grandmothers and mothers who were not very conversant with apps, etc., have become far more comfortable with them. I think that is 100% true. I think what we will see and we should see from everything we've heard from all the speakers today is that at some time in the near to medium term, there is a very bright future ahead of us, hopefully, if everything happens. And we've just got to see people get off the rear view mirror and start looking through the windshield and hopefully, all help in one direction. And I say this for the private sector. I think they are a little bit of a laggard on the investment side. I say this for foreign capital that is still sitting on the fence. I see it for people who want to come into the manufacturing sector in India, but find the ease of doing business quite difficult. I would encourage them, and I would encourage my brethren from NBFCs to start looking at how to work with banks, if not for a bank license itself.
Yeah. Mr. Vednathan, one last question I just came to me. There's this big startup thing coming up. I mean, and mostly all these new businesses. And I'd like a very quick answer because we're short on time. Now, how comfortable would you be? Because it's mostly PE and VC funding that generally happens. At some stage, I mean, do you think banks like yours or others, would you step in, take the risks there, or you'll just leave it at PE and VC? You don't want to enter that domain because profitability is an aspect there. Yeah.
Actually, I didn't quite get the questions regarding startup. If you expand one last.
Asking all these tech-based companies, so much of them are coming. Mostly they are funded by PE and VCs. At some stage, do you see
I get that.
stepping in? Yeah.
No, I get that. No, I get the question. No. Actually, we should respect all of them, and because all of these are young entrepreneurs who are setting up some entity or the other, and that's how India will grow when we create so many entrepreneurs. I actually love the concept that these young entrepreneurs get equity backing from somebody or the other, and that's how they all start in life. That's how at least we also started in life. So it's a great thing. We want to respect that. I also think that in terms of opportunities for them. They are actually, we talked about the new digital ecosystem that is coming for us. Their ability to ride on that ecosystem and create new business models is really there, which did not even exist 10 years ago. So I really think very high of them, and I think so. The only thing is that many of those businesses are entirely complementary because it's supporting the whole chain. Some of them, there could be some competition because the issue is often about who's touching the customer interface layer. And sometimes that becomes a conflict. But I think these are dynamics the industry will have to work out.
Okay.
Yeah,
On that note, we now,
ma'am,
we're really, yeah. Okay,
just
20 seconds. Yeah.
It's also important that these startups get some working capital and debt capital, because cost of equity is high. And somewhere the whole system needs to think about what's a good way to assess them, because cash flows are in the future. That is the reality of that marketplace. So I just wanted to get that one word in.
Right. Thank you.
Thank
you. On
he
that
meant
note,
finance startups actually.
On that note, we now come to the end of this discussion. I would like to thank my three speakers for their views and insights, and really thankful to you. It's been wonderful listening to you three, and also thank my audience for their interest. The session will be available on demand for a minimum of 30 days on the event website. In a few minutes, we'll be joined by our next keynote speaker, Mr. Uday Kotak, Managing Director and CEO of Kotak Mahindra Bank, who will pick up on the discussion that we just had, and I'm sure he will provide his expert views on the growth of Indian economy and role banks will play going forward. Thank you. Thank you so much, everyone.
Thank you, Sandeep, Jaspal, Ashu, all of you. Nice meeting you.
Thanks.
Thanks.
Thank you.
A warm welcome to everybody who's joined us for this interesting session with Mr. Uday Kotak. Good afternoon, good morning, and good evening to people at different parts of the world. Thank you so much, Mr. Kotak, for joining us in this keynote session. While Mr. Kotak doesn't really need an introduction, he's been an inspiring businessman. He's built a brand in the banking industry whose defining features we all know are trust and customer centricity. Probably his is the only bank which carries the family name in Indian banking. Many, no wonder all entrepreneurs and business persons alike look up to him and learn from the journey that he has made over the last 3 decades or so. Mr. Kotak was born and brought up in a joint family of 60. He grew up in Mumbai, has been passionate about cricket, which he himself played till he was badly injured when he was just about 20, and he had to undergo a surgery then. He also played sitar, but then consciously chose to be a businessman. Mr. Kotak is straightforward, he talks to the point, and is often sought out by the government on critical issues pertaining to the Indian economy. Welcome, Mr. Kotak, to the Financial Times Indian Express third episode on India's place in the post-pandemic world, which focuses on banking and the capital markets. I'll request all the audience members to ask their questions whenever they want on the right-hand side of the chat box, and they can also tweet their thoughts in social media. using the tweet, using the hashtag India in the world. Mr. Kotak, thank you for joining us once again. If I might just turn you back over the last 1.5 years, COVID-19 has really turned things on its head in India, and not just in India, rest of the world as well. And even as we were still recovering from the second wave, which peaked in April, May, there are talks and concerns about the third wave. Before I focus narrowly on the financial sector, banking and capital markets, and given the benefit of hindsight, what would you think India could have done more to mitigate the burden during the pandemic?
Vaidyanathan, as they say, hindsight is 2020. But what I do believe is that the approach of India in retrospect may turn out to be better than what we may have thought about, particularly in the month of May 21, when the pandemic 2.0 really hit India very badly. What I think is happening is countries which have closed down completely, like New Zealand or Australia, or even a place like Singapore, are struggling to come out of it to a normalization. Therefore, in many ways, India keeping its movements more open and getting that balance between lives and livelihood at a time when COVID doesn't seem like going away tomorrow, and it's something which is going to be more and more a continuing part of our lives. I think we have no option but to accept that we will have to be more careful via social distancing, masking, and measures like that rather than lockdowns. So, all, I think many of us Indians in the period January to March dropped our guard, particularly with normal precautions on COVID. We could have done that better. But otherwise, I think at this stage, a very large part of our population has either got COVID, and more parts of our population are also getting vaccinated. So between COVID and vaccination, we are covering a larger and larger percentage, which is a good thing. Therefore, I am at this stage, after the intense pain of May 2021, a month I would like to forget in our history. I would say that India is coping up reasonably.
That's right. Almost 70% have got at least one shot of vaccination so far. That has been a remarkable pace. Mr. Kotak, one thing which you have been also saying in the past during the course of the pandemic is for more, say, accommodative stance by both the government as well as the Reserve Bank of India. You've been calling upon the government to spend more. But where does the money come from? Because the fiscal space remains limited, and like Boris Johnson in the UK, I'm not sure whether India can really think about raising tax.
So Vaidyanathan, I would focus on the budgeted fiscal deficit 21-22. After a 9.5% central government deficit last year, this year's budgeted deficit is 6.8%. The revenues actually have been more buoyant than what the budgeted estimates were. And so far, expenditure has been under control. So I actually feel the finance minister has created space for herself to be able to do some spending over and above what may have been planned in the next few months. Therefore, I do believe that India is now getting its fisc much more under control compared to what we had budgeted. And there is room for us to be spending more than what we had bargained earlier, thanks to a more buoyant tax revenue situation as well. So I actually feel in this festive season and beyond, between now and Jan-Feb, India has an opportunity to actually up the spending on the fisc within the overall budgeted deficits planned. Therefore, India with an additional spending can still keep its budgeted deficit in line.
That's right. That's right. One thing which happened during the pandemic, or even before the pandemic, the Indian banking sector was battling bad loans even before, say 2020 2019-20, the bad loans were pretty bad. Now there are fears that banks will emerge more scarred than before. There are reports. Indian Express also reported about mudra loans across states like Maharashtra, Gujarat, UP turning bad. Do you expect a prolonged period of pain before the banks get back to shape? Uh, and do you think that would have an impact on economic recovery as and when it happens?
I first of all, what is helping is a very accommodative policy. So that is certainly helping the banking system tide over this very crucial period. Also, some of the measures to alleviate the pain of the borrowers, particularly the MSME, like the credit guarantee program by the government of India for MSMEs, and some of these other programs have actually supported the weaker parts of the economy. What has happened in reality is that there are companies which have gone stronger in the COVID period, and the middle and the lower end companies have found it more challenging. What I think we really need to focus on from the financial sector point of view is to have shock absorption capacity. So most banks and financial institutions in the last 12 to 15 months have actually raised capital. Therefore,
Right.
I believe Indian financial system today is much safer to take the knocks. And my view and something which I share with my colleagues from the financial sector is time has come for us to take the knocks if they come, but go out there and lend, because going forward, I feel positive about the credit cycle in most pockets. And in the stress pockets, I think government has given guarantees. So I'm actually quite optimistic about how this turns out. And we must be careful not to look at the rear view mirror too much, but look at the windshield in front.
Right. One thing which, absolutely, the ECLG, the Emergency Credit Line Guarantee Scheme, did, push credit to the SMEs. But, credit to services, large industries have, of course, remained very subdued. But what is your assessment of credit demand itself and of banks' ability to lend or willingness to lend? Do you see that kind of picking up because industries are still working at 70% capacities, and banks are still not lending?
Vaidyanathan, what has happened because of COVID is a lot of supply constraints outside the control of industry are coming. For example, the semiconductor supply constraint that is affecting the production of, say, passenger cars. Therefore, there is a demand for passenger cars. There is in many cases a waiting period, but the cars are not coming out because of lack of some crucial components. Therefore, really, the supply constraint is a bigger issue at this stage, which is leading to a shrinkage of even existing capacity utilization. So at this point of time, we are not seeing a massive demand for new investment, particularly in the private sector. But I am actually of the view that private sector's best opportunity to invest is now. When the going is tough and before it becomes sunshine, I think we must create more capacity for a time when things will be better. So my view between 15 months ago and today has changed. 15 months ago, we did not know the complexity of this animal called COVID-19. Now, I feel that yes, COVID is lingered much longer and may linger for a while. But we have got some handle about what the critical issues around COVID are and how we can navigate our economic objectives even in this period. And that is something I would focus on. Therefore, I would go for higher growth as the core to building the business and the economy from here.
So, in your conversations, Mr. Kotak, with industry captains, when you meet them or when you speak with them, do you get that sense of say readiness to invest, go for investments? What has been your general impression?
From whatever I'm hearing, industry captains are ready to invest more, but they would like to see sustainable demand come back and supply constraints go away. But I think we are ready. We are probably not very far away from a positive investment cycle. Therefore, I am of the view sometime in 2022 or early 2023, we will see a sharp pickup in private investment.
That's quite encouraging. Mr. Kotak, one more thing which kind of, troubles, or where people have concerns is about the banking industry, or many banks, be it private as well as public. They're all focusing a lot more on the retail side. Uh, this has been a problem for long. Who will lend to the corporates for infrastructure? All this which require long-term loans, without, of course, which the economy also can't grow.
So, Vaidyanathan, a structural change is happening in the economy and the markets and the financial sector. There is much greater participation by capital markets, both in equity and debt financing. Therefore, a lot of the corporate sector is now getting financed at more effective cost of capital from capital markets. And you are now seeing many new players coming in that part. So in addition to what they were doing traditionally, banks are seeing financial services players in the markets actually beginning to take a fair share of the overall financial sector. Therefore, look at the financial sector holistically. Markets are taking a larger portion. You have infrastructure funds, you have special situation funds, you have alternate assets of various nature, you have private equity, you have debt markets, you have structured debt. All those instruments are funding the corporate sector as long as the underlying project or business is viable. And with low interest rates, the expectations of IRR have also got more modest. Therefore, the power of markets is changing the financial services space in India. And banks have to recognize that they are now competing with a completely new animal they never had to compete with, which is debt and equity markets. Simultaneously, I think there is a technology revolution which is happening on the financial intermediation side. The banking industry is gearing up also for the digital play, customer in perspective, simultaneously. So the two big areas of pressure and opportunity are in the financial space are markets, digital and technology, and banks and financial players will have to adapt to this new world.
Absolutely. But so do you think that there is, in the way, say, the private sector banking reacts to such challenges, and the public sector banks which react to such challenges, do you see a divergence in that, or do you see public banks still have a lot of ground to cover?
The marketplace, the customer does not look at between private and public. The customer looks at what is good for her. And that is where we have to be clear. Let us get beyond ownership as the basis of how we play. We have to be on our feet, on our toes, and forget private and public banks. If we are not careful, the Googles and the Amazons will eat our lunch. Therefore, shape up or ship out is what I would say is the future for financial services players.
Yeah. One thing which many people talk about, some are very happy about it, some are very sanguine, is about the state of the stock markets. The price earnings ratio of the stock markets are at a 27% premium to world markets. We are the fourth best amongst the top 50, with a 25% growth in market cap during the year. Does this worry you? Does this exuberance worry you at times?
Which of the two roads is the market telling us? One is markets, are they ahead of what is going to happen and therefore are showing promise, which we are so far not seeing in actual economic numbers to the same extent? Or are the markets bubbly and too exuberant? I don't think I would discount the markets completely. There is a change in the air. The future of the world in a newer and a never normal post-COVID era is going to be different. Therefore, there will be new winners. There will be some existing players who will be able to transition, and there will be players who will be left behind. Therefore, it is a call which the markets are taking. Markets may be right or wrong on individual stocks, but markets are seeing the change and pace of change. The other factor you have to keep in markets is the current rate of interest rates globally, as also the enormous liquidity is bringing down the discount rate for future cash flows. And therefore, obviously the asset values are going up with such accommodative and easy money policy. So you have a significantly higher present value of future cash flows, and markets are ready to discount well into the future. And at the same time, there is transformation in the world. COVID has brought forward 5 years change in 1 year.
True, true. So that, in the sense that, for retail investors, would you want to tell them anything at this point of time?
Never make the call of whether market is too high or too low. Go by your own risk appetite and have a proper portfolio allocation strategy. If necessary, go to a good financial advisor, and do not fall into the trap of why my neighbor has become so wealthy and I have been left behind. Do what is right for you.
Yeah. Mr. Kotak, one of the things which has been hotly discussed and debated in India is about, recent working paper of the Reserve Bank of India, which talks about giving banking license to corporate houses. How do you look at this issue? That is a strong view that we need to dramatically increase banking capacity in the country. But given the effectiveness of supervision, and it takes a lot of time, and you can often miss the connectedness of corporates. How do you look at allowing corporate sector? Does it? Do you think it's time now?
First principles. Easier barriers is easier entry. That means lower barriers to entry. Must also recognize easier exits. The challenge in banking and financial sector is you cannot have easy entry, but for every exit, there is a bailout required. It cannot work on a sustainable basis. It is like creative destruction that is a part of life. And I don't think the financial system still is ready for painful exits of financial players as we have seen. And in the last few years, we have seen the challenges we have faced in almost every segment of finance. We have seen a challenge in the NBFC segment with IL&FS and DHFL. We have seen a challenge in public sector banking with the Nirav Modi episode in Punjab National Bank. We have seen a challenge in private sector banking with Yes Bank and to a certain extent Lakshmi Vilas Bank. We have seen a challenge in cooperative banking with PMC Bank. Therefore, there is every segment of the financial sector in the last few years which has gone through significant issues on how these institutions were run. And one of the big issues we have found in many of these cases is convenient lending between so-called friendly players amongst themselves, as we can see some of it coming out. Therefore, how well can we make sure that the guardrails for ensuring no such mingling happens? And think about a large conglomerate. Even if you stop direct lending from a bank to the large conglomerate, how are we going to control lending to their suppliers, lending to their buyers, lending to people who may have direct or indirect connectedness across services and the real economy? Therefore, if the central bank is comfortable that it can do it well, keeping in mind history of some of the challenges we have faced, it's a different matter. But otherwise, I would say it is something which needs to be very carefully watched, and we should be not rushing where angels fear to tread.
Yeah. Mr. Kota, we have a barrage of questions from the audience. Let me take a couple of them. One is about, how can we address the issue of bad loans? Is repeated capitalization advisable?
Finally, capital must get a return. And if bad loans happen, we have to clean up the system fast. And investors should ask the tough question: am I putting my money, which is good money, after bad, or am I going to see a return on my capital? And these are very tough questions investors must ask and be surgical about. And there is no easy answer. Stick to the knitting. There has to be a return for investors for risk taken.
Yeah. There's a question which concerns your bank. It says Kotak Mahindra Bank has just announced that it will offer home loans at 6.5%. How will banks ensure profitability amid such low interest rates?
Vaidyanathan, one of the things which the pandemic has done is dramatically reduce the cost of funds. At Kotak Mahindra Bank, we now have amongst the lowest cost of funds. Our CASA deposit ratio is in excess of 60%, and therefore we have been able to so dramatically reduce our cost of funds that we thought it is appropriate for us to give a festival uh, benefit to all the customers in one of the most important products in the pandemic era, which is the home loan. The home has become the center of people's life, and the need for a slightly larger home, a new home, is one of the most lasting aspects of COVID. Therefore, we want to reach out to our customers and all Indians that this is the time for you. If you would like to buy a home, we are there with you, especially on the eve of one of the most auspicious festivals in India, the Ganesh Chaturthi tomorrow. And we have announced we will provide this very special 6.5% home loan rate for all customers and prospective customers between now to post Diwali. And I would request, let us go out there, get the consumer back, and back to what you said, we want to get the economy up. And we as a bank can play our little role in improving India's economy and a better opportunity for our customers.
Yeah. There's another question about what is the extent of mobilization of international debt securities or dollar loans by the Indian private banking sector? Are we hedged to avoid associated risks such as interest rate hike in the US?
I think Indian banking is much better risk managed today on the international side, especially including open positions. And on that, I think the RBI has also got pretty good guidelines. Therefore, I would not be worried about that. In fact, the problem today is most of us are running huge surplus dollars and not knowing where to deploy those dollars.
Yeah. Another question of about how much do you think, Mr. Kotar, about Indian banks boosting earnings by further reducing cost income ratios as compared to simply growing the loan book? If there is one fintech technology, what is it you would invest in?
I think time has come for banks to revisit how many branches do you really need. Okay, if digital is going to do a lot more work, logically you don't need the same number of branches in a digital era. I think branches still at a base level are important, but the density of branches can come down. And very significant opportunity for banks to increase the productivity, efficiency, and effectiveness of its entire overall network plus the structure to get far more efficient in the days to come. But the way to do it is actually either you just focus on costs, but I would much rather focus on growth and keep the costs under control so that you improve your ratios.
Right, right. I have many more questions, Mr. Kotak, but I think we are running short of time. Uh, really, thanks a lot for squeezing in time for this session, despite the multiple demands that you have. Uh, I would also request, I'll also like to remind the audience that this session will be available on demand for at least 30 days on the event website. You can, uh, in a short while from now, my colleague in Financial Times, Benjamin Parkin, will be chairing an interesting panel on India's capital markets. Please stick around. Thank you so much.
Thank you. Thank you,
Thank
Vaidi.
you so
Thank
much.
all your
Thank you.
all the viewers. Good to be on your platform. Bye.
Thank you.
Hello. It's been an eventful couple of years for watchers of Indian capital markets. Covid has been difficult for India both economically and health-wise, and yet equities are on a gravity-defying tear. Credit markets have seen some volatility and churn, but we all hope that the worst of the pandemic is behind us and there are signs the economy is picking up. So today we'll discuss what role capital markets can play in that recovery. Here with me to discuss this is Anita George, the Executive Vice President and Deputy Head at CDPQ Global, Rashesh Shah, Chairman at Edelweiss Group, Yelan Sijdikov, the Global Head of Emerging Markets at Amundi, and Ashneer Grover, the Managing Director and Co-Founder at Bharat Pay. Please use the Q&A box to the right of your screen to ask any questions at any time, and we'll come to them towards the end. You can post about the event using the hashtag #IndiaInTheWorld. So Indian equities are on a run, breaking record after record, including even this week. But to what extent do capital markets reflect India's economy? And do Indian stocks give us a reason to be optimistic about India's recovery and growth prospects? Rashesh, can I start with you?
Yes, sure. Thanks a lot, and very excited to be here. Thanks, Benjamin, for this question. And I think markets are hitting a new high, and everybody is trying to figure out uh, has the economy taken a U-turn, or is COVID behind us? Is a slowdown behind us? I think, in one word, the answer is I think the good stock market are they do forbear maybe a indication that the economy is on an uptick. But we should remember a couple of things. One is the Indian stock market is only a part reflection of the economy, because India still has a large informal sector, a large agriculture sector. A lot of them are not represented. A lot of SMEs are not part of the market, and even the stock market. The I think the top 200 companies are about close to 90% of the market capitalization. So the stock market does reflect a small part of the Indian economy as a whole. And but having said that, I think the market is also a barometer. It is a barometer of the animal spirits that are coming back, the optimism that is coming back, and and all these listed companies, the large companies, have a lot of linkages to other parts of the economy. So they do act as a barometer, as a indicator of things to come. I think broadly the market is hypothesizing. The investors in the equity markets are seeing a lot of growth ahead of us. And if you see the Indian economy over the last 8 years, we have been in a slowdown. Corporate earnings has grown at approximately 3% a year over last 8 years. So there has been a significant degrowth in or slowdown of growth in corporate earnings. So I think there was a 8 year slump, mainly because of this NPS in the banking and the corporate sector deleveraging, the private capex coming down, all of that. But along with that, 3 years ago we had ILFS, which resulted in a medium-term downtrend. So we had a long-term downtrend, then we had a medium-term downtrend because of ILFS, and obviously then because of COVID, we had a short-term downtrend. I think all three, the long, medium, and short-term downtrend, are coming to an end, and there is a clear uptick. And part of the uptick could be just a cyclical recovery after 8 years of slowdown in corporate earnings. So I think the corporate earnings, which have been growing at about 3% a year for the last 8 years, a lot of analysts and investors, all of us believe that corporate earnings will now grow between 12 to 14% a year for the next 4 to 5 years. And I think that is partly what we are seeing in the market. So I think, as with everything else, the market being so buoyant and hitting new highs is a glass half full from an economy point of view, but it does help. It will definitely help the economy going forward.
Great, thank you. And Anita, as a foreign investor, how have the events of the past 18 months or indeed 2, 3 years changed your views on India, if at all? These various downtrends that Rashesh had mentioned.
Thank you, Benjamin, and I'm very glad to be here with my fellow panelists and the audience today. Uh, I just wanted to say that I agree on the big picture with Rashesh, but coming from a global perspective of looking at the whole world as our stage, the asset allocation has depended a lot on what's happening elsewhere in the world just as much as what's happening in India. So just putting it in that context, in India, I think as Rashesh mentioned earlier, there were already headwinds, particularly in the financial sector. And now we see that thanks to COVID and the two waves that happened, the initial wave actually had a more severe impact on the economy, uh, whereas I would say the second wave had a more severe impact on the social fabric of and the health infrastructure, and kind of revealed the weak points in the economy. However, we have been pleasantly surprised in terms of general trends, and especially now, as Rashish mentioned, there's a pickup in demand. Of course, the sectors such as the ones that e-commerce, sort of the digitized part of our world, has done much, much better. We are seeing also sectors such as the even the startup world. Recently, there was an analysis, and I'm very glad that Ashneer is here, and he can give us more of a flavor of that. But there seems to be a lot of activities, whether it's edutech, fintech, health tech, in all of, and even agri-tech. So, and that's one of the strengths of India that we see, the entrepreneurial spirit and the private sector, where we continue to be impressed by that. And our investments are across all asset classes, including liquid ones, the listed equities, and as you mentioned, the market has been on a roll, which is great. We have also private equity investments that have gone through their downturns but are now picking up again. And in infrastructure, which is another sector where we feel that India holds a lot of potential, as well as real estate. So I would say overall, we remain positive and continue to invest in India.
Great. And Yelan, thinking about emerging markets specifically, how does India line up alongside, say, I mean, China most importantly probably, but also Russia and Brazil and so on, from your perspective?
Yes, thank you very much for this opportunity. India generally is one of the largest opportunities in emerging markets from our perspective structurally, and we see it in a long run. Of course, we had a bit of a wobble this year, given the severity of the impact of the virus, which was at least perceived by the markets as a larger impact on the Indian economy or in Indian population in general. But of course, if you look at the per capita situation, India was pretty much in line with what's been happening in other countries in Latin America and specifically, and also in Asia now. So, but of course, the impression was that the situation was not well managed at the time, and of course, this also reflected badly on the investors' valuations and flows in general. But however, of course, as Anita also mentioned, is that we also need to look at the complexity of the situation, and now that India is doing fairly good job catching up on vaccination. That was a major factor. Now we're seeing a much faster vaccination rate at 6 million plus per day. So I think this is really, really very important that India continues on that path. And of course, what's been happening in China on the regulatory side, the crackdown that we've seen in that country also pushed some of the investors to reallocate money within this high growth area away from China into India. So India has been a beneficiary of that, if you want, flows that we're looking for, less controversial from a regulatory perspective and less controversial from the geopolitical perspective, a destination of growth. So that's why we still believe that India represents a very good opportunity on growth side, and investors were pretty happy, really looking beyond the current weakness in economic terms and looking for the recovery that definitely will take place over the next few quarters. In terms of earnings, already Rashish mentioned that earnings were pretty much in line. Of course, the valuations have been stretched already for some time, but of course, as Anita said, investors are now looking at the productivity growth, which will be accelerating with the advent of the new exciting opportunities in IT sector, in the new economy, e-commerce, all of these exciting opportunities that came to the market and were experiencing significant demand from foreign investors. And of course, going beyond that, of course, we're seeing also a pickup overall in growth, given that India has done also very well in managing expectations on monetary and macro policies.
Great. And Ashnia, speaking of the regulatory crackdown in China, I guess that's affected some of your peers over there. But so there's been a very bullish mood around Indian tech companies and startups, and there's been a rush of companies looking to invest, including to list, including payments companies. What is driving this in your view, and what do you make of it?
So Benjamin, it's all about timing, right? If you look at it, most of the companies that you see today at scale were started some private money. All of your SHAs normally 7 years to list or provide some form of exit to the investor. Now that 7 year in for most companies has also become that would have to come back to the investors, and so uh, 10 years. In the US markets. And therefore, that is giving a lot of confidence to the same set of investors to also back IPOs of tech companies in India. So, from a capital market perspective and from maturity of certain businesses perspective, it's good confluence of the two, which is leading to the current wave of tech IPOs. And of course, the money is right now is available plenty and available pretty cheap, and that's why you're also seeing the valuations play out. So I think that it's just I believe this is like the first innings of a when we are playing as tech companies in the stock market. Hopefully, the people who are listing now do well and make good returns for public investors as well, not only their private investors, right? And if they make good money for public investors and hold the prices over the next few months, I think then that will open the real floodgates for tech IPOs to follow in the next couple of years.
Great. And please forgive me, but I have to ask, what are your plans, if any, on that front?
I've just been around for 3 years, so I have another 4 years not to trouble myself about going public. And see, my fundamental view remains here is the same. If you think your business is stable enough to handle quarterly reporting and results and exciting the analyst on a quarterly basis, please go ahead and do a IPO. But if you're still in the building phase, right, and you still believe there's a lot more disruptive things you need to do, which does not allow you the time to go for quarterly numbers, but focus on the bigger things, then you're better off being private and creating more value being private. So we've just been around for 3 years. At least for another 4 years, I have no obligation on me to give a return of capital to my investors. So I will stay. Maybe the next wave is what I will catch.
Okay. So, moving on from equities to debt and credit markets, that's an important part of this question of helping the economy recover. But Rashid, you mentioned the ILNFS incident in 2018, and for people who don't know, it was a large infrastructure financier that had to be rescued in fairly dramatic fashion, and it caused a shock in debt markets. So what's the state now in those markets 3 years later, given all that's happened, including COVID, not least?
Actually, I'm happy that you're asking this question about Indian credit markets, because I think uh, the Indian financial system has been a story of two different markets. I think one is equity markets, where there is a lot of optimism and euphoria and all, and the credit markets, which over the last actually 7-8 years, they have been very correlated to corporate earnings and corporate activity slowing down. And when we say credit market, there are actually three parts of that. One is the bank loan and the NBFC loan market. The loan market is almost a 70-75% of the Indian credit market. Then we have about 20 odd percent of the bond market, and another 3 to 4% is the private credit market, the close-ended funds and all that. So I think the loan market for the last 8 years has been fairly depressed. As you know, there was a lot of NPAs in the Indian banking system, and the cleaning up, and the new IBC code coming in, and RBI had forced banks to recognize through what was called an asset review, quality review. As a result of that, a lot of credit slowdown was happening for the last about 8 years in India. The bank slowed down first, NBFCs continued to grow. Last 3 years, NBFCs also slowed down. Along with that, I think post ILFS was a much bigger shock for the bond market than it was for the bank market, in the sense, because the banks had a shock earlier with the NPAs that had accumulated. For them, ILFS was not that big a shock, but for the bond market, ILFS was a very big shock, and they were following a couple of other housing finance companies which also defaulted. So the bond markets have gone into a big shock for the last 3 years. And then there is a third element which I call the private credit markets. They are doing very well. So I think if you ask me the current stage, I think the credit markets are very cautious, unlike the equity markets. And I do feel that if the Indian economy is to recover, and and the equity market euphoria and optimism is to translate into real growth uh, across the economy in a balanced way, credit market will have to kick in. So all of us are waiting with with bated breath in terms of that the credit markets start becoming aggressive. So if you see, credit growth for the last 3 years in India have been about 5 to 8%, which is a single digit. Our nominal GDP growth is 11-12% every year. So you would expect the credit growth, which was usually 1.5 times the nominal GDP growth, is now growing at half the nominal GDP growth, which is untenable. And I think credit is a much larger part of the economy than equity can ever be. Equity can be the bellwether part, but it can never replace credit in the economy. And I think hence the credit markets are still very cautious, very subdued. If you look at bank lending and all after COVID also, because there have been retail NPAs also building up. So last couple of years, the credit markets have been very depressed, and the bond market especially had a big dislocation. We had a large mutual fund which had to close some schemes because of lack of liquidity in the bond market. So unfortunately, the bond market was starting to develop, and the last 8-10 years, their share of the credit market had been expanding. As I said, they are about 25% of the market now, but they've gone through a big shock. I don't think they've come back. Now the current bond market is only AAA rated, and anything which is not AAA has no market, and you can't have a bond market with that. The credit market is slow because the banks are still cautious after COVID wave 2. The private credit, which is a small part, about 4% of the market, is doing very well. It's growing very well. We are very fortunate. We are one of the players in that. But the loss of some opportunities by the bank market and the bond market is coming to the private credit market, and it's actually very similar to what happened in the US post 2008. The real explosive growth of private credit in US happened after the global financial crisis. We are seeing early signs of that. But I think for the economy to do well at a broader level, the credit growth has to get back to 12 to 14% economy. So if you really want to assess if this euphoria of the equity market can be sustained into real economic growth over the 5 7 years. As I said, corporate earnings will grow because corporate earnings have been depressed for so long, and all this liquidity and euphoria of equity markets is going to help corporate earnings. But for that to be translated into real economic growth, credit markets will have to kick in. They will have to do their share, and everybody from the finance minister to Reserve Bank, everybody is watching that, and that will be the key. I think it will take us another year to form an assessment of the future growth of credit market, but it is something I would watch very closely to see if the real economic growth is getting translated, because you can't have equity markets here and credit markets here. They both have to be in sync. I'm hoping that credit market reflect the euphoria of equity market and not the other way around. Thank you.
Yeah. And Yalan, how does that compare with other emerging markets, this slow growth, caution that Rajesh has described? And for you, what kind of opportunities are there in Indian credit?
Yes, just reflecting maybe on another part of credit market, the external one. We also had been expecting faster growth in credit markets for the past 10 years. It's been probably hampered by very similar reasons. As Rashish mentioned, is also the banks. The issue with the recapitalization of the banks, the health of the banks was probably one of the fundamental reasons. But the other reason, I think, is regulatory, where we had we had no opportunity for the true high yield companies in India to come out and access external markets as well, which would have been also an opportunity for some Indian companies due to the coupon caps that have been imposed on a regulatory level. So I think if that was not the case, probably there would have been also a small but interesting high yield market. If you really compare it to the Chinese market, this was allowed by the government. Of course, it's creating some ripple effects now, as we know that the big stories on the property side. But allowing defaults to happen and testing the insolvency mechanisms is sooner than later needs to be done, and I think this would have been a very good development if I were to put it on my wish list from the external investor perspective. And if you really compare it overall fixed income market and credit market in particular, I think that the recent developments here now with the inclusion of India or into the index that we're expecting from the next year, that will bring in anywhere between 20 to 30 billion of inflows into Indian fixed income market. I think this also will help and push the proliferation of the credit markets, and hopefully then an opportunity for Indian companies to start accessing this market. And I think if regulatory environment changes and allows for this market to develop, given that the banks have been gradual and slowly also improving its financial position, I think there would be a much less of a crowding out effect of this large issuers that we had seen dominating the external market, like the types of Adani, Tata, JSW, and we will have a truly smaller and medium-sized company being able to access. The biggest, why I'm really optimistic about this, the biggest area of growth, I would say the explosion of the market has been on the green side, with a lot of renewable projects, refinancings in the bond market. I think this is really a very, very great development. So hopefully with that and the very strong demand from investors for the green investments, I think this is also an opportunity for Indian companies to start tapping that market. in a more aggressive way. So, in terms of overall liquidity, already Ashish also mentioned that it was probably a somewhat lower level of liquidity, given the lower level of involvement of foreign investors, which would have helped. Dominant players, obviously, are the Indian banks. If there wouldn't be a crowding out effect, I think there would be an opportunity for probably better liquidity conditions, and I expect them to improve as a corollary effect of inclusion of India in the bond market, as I mentioned. So I think this would be definitely a welcome development, and regulatory side already has been very helpful from the inclusion index inclusion perspective. Lots of things had to be done, and will probably be some more things on the settlement side that could ease a little bit the settlement process for international investors, and will also spur development and demand of the Indian credit market.
Actually, if I may add another point out here to underscore this point, the last 25 years, I think Indian equity markets have grown very well. We had private equity come into India 25 years ago, and they played a big role in providing early stage risk capital and all. We have had, the exchange, the online exchange, NSE and all came in 25 years ago. So the equity markets in India last 25 years have been a fabulous story. A lot of foreign players, a lot of heterogeneity, Indian mutual funds, FPIs, all of that. There is real, I think, market have grown very well. Unfortunately, on the credit side, we have not had that. And what earlier Yalan was saying, I think that will be when we get more foreign investors into the credit market, into bond market, when we get that heterogeneity, when we get then the bond market and the credit market will be fairly similar to what has happened in equity markets. We do believe the next 10 years will be about credit markets in India. I think 25 years ago, we got private equity in India. Now, hopefully, we'll get private credit, and the same global players will come to India and provide, high yield credit opportunities, stress credit opportunities. All of that will come to India.
Yeah. Ashneer, I'd like to ask you, because you part of your business is lending to small SMEs, small enterprises, and so on. They have been hard hit by the pandemic. Like that's often part of the informal sector, as we've already talked about, and they've also been struggling in general to borrow from banks and non-bank financial companies and so on, who have been more conservative and more cautious because of the stress in the informal sector and the retail sector. What do you see? When you're speaking to some of these small businesses, what are you hearing from them?
Yeah. So if you look at the Indian banks, see, they are very happy lending to a certain segment which they understand and which they've learned over years. But then there is a large segment of small shopkeepers and small enterprises, which the banks are very wary of, right? They will always put it as unsecured lending in their risk parameters and not take too much risk there. What I see is that if you look at the segment that the banks want to lend to today, actually you end up making the same NIM anyone else would make in the US or in the West, right? So the rates have fallen so much, right? Today you can borrow for a home loan at 6.75%, right? Kotak is giving you loans at 6.75%. Now, 6.75%, you know how low the NIMs are. And which means there's a lot of capital with the banks to lend. The unfortunate part is they're not going to the other end, which is saying, okay, let's take more risk and potentially slightly more yield to start with and explore that market. So that's not happening. And I'm not complaining, because that is leaving opportunity for people like us to bridge the gap. So we do unsecured lending, and we do it to the shopkeepers based their payment volumes, right? And that's our business in a nutshell. Now, in the pandemic, what has happened is uh, the banks and the NBFCs have gone even quieter, right? For this segment, so it's just a flight to safety, and they've just left this segment high and dry. And this is incidentally the point when they need this borrowing the most. So actually, the demand for borrowing has gone up in SME, and the formal credit available during the same period has come down, right? Because people are saying, I'm in the business of collection, I'm not in the business of disbursal to this segment anymore, right? So which is giving opportunity to the fintechs to come and play, and that's why you see a lot of activity in SME lending among fintechs happen. My view is banks generally don't want to lend to this segment, right? Like you can explain to them, you can reason with them. They want to play a safer game, and this segment would be taken away by fintechs over time, and it'll be basis alternate data, but it'll be very specific alternate data like payment volumes, UPI volumes, which is now a good proxy for how much business a person is doing. So that's where I see it. Huge opportunity, $500 billion opportunity of lending into this segment. But the secured bank, the bank and the formal sector is not playing any incremental role as I see it.
Thank you. So moving on a little bit to long-term investment in infrastructure and renewable energy, things that India needs, right, as a country of nearly 1.4 billion people. But investors have often been reluctant to get involved because of the risk of projects getting stuck, things going wrong, and that's part of the legacy bad loan problem. Anita, you are coming from a pension fund, you're kind of thinking as long term as it gets, I suppose. And it seems that there has been growing interest over the past 5-10 years from international pension funds and sovereign wealth funds in investing, say, in Indian roads, as indeed you have. What has changed, and will this be enough to provide the capital that's needed?
So thanks, Benjamin. If you go by the National Infrastructure Investment Plan, India needs about 1.4 to 1.7 trillion are the numbers that I've seen for the next 3 to 4 years. So huge demand. There's no denying that. And for a pension fund like CDPQ, as well as other Canadian pension funds, other pension funds, as well as the sovereign wealth funds, infrastructure is a ideally suited asset class. In fact, internally, jokingly, we call it our gold. And the reason for that is with the kind of long-term liabilities, we are looking for long-term assets to invest in. The opportunity that India has presented precisely for the reasons that you mentioned, where you had a lot of aggressive bidding, assets being built, but financing becoming stressed, etc., and the large numbers of NPAs which are there in the industrial sector and in infrastructure sector. Actually, that presents an opportunity because there is a universe of brownfield assets that have become available in the market, and for institutional investors, having assets that are already built out, so de-risked to some extent, the ability to demonstrate that you have a track record of, let's say, in the road sector, traffic patterns. And despite COVID, it's interesting that a lot of the assets have bounced back in terms of traffic, etc. And the approach that institutional investors like ourselves are taking is actually to create platforms that can aggregate individual brownfield assets. And the benefit I see of that is by aggregations, you can get economies of scale, you can improve performance. I think both Yerlan mentioned, ESG and sort of good practices which can attract more capital, long-term capital. So from all those perspectives, this has become a sector. And most recently, the government also has given a tax exemption for institutional investors, both pension funds and sovereign wealth funds, for infrastructure debt and infrastructure equity. This makes a huge difference because if you look at the volume of long term institutional capital that's available, around $140 trillion, India gets a very small percentage, something like 0.03%, relative to India's contribution to GDP, which is about 3%. And this discrepancy is actually been because of the multiple levels of taxation and high levels of taxation. So this exemption, in my view, will help India become even more attractive as the destination for long-term infrastructure investors who are looking for stable and predictable yields. Of course, there's a lot more that can be done in terms of greenfield investments, because if you look at the number of buildings that have to be built, some of the numbers I've seen is that three-fourths of the buildings that need to be built are yet to be built. So given all of that, I think this sector becomes an important sector, and it's ideally suited for long-term investors like ourselves.
Interesting, thank you. And staying with you, investors are watching around the world for signs of tightening in global liquidity and with the Fed, whether they'll start to get their pandemic era stimulus. And people such as Geeta Gopinath from the IMF have warned about the impact this could have on low and middle income countries. Do you see any risk of a kind of taper tantrum style episode in the months or years to come?
So I think most of the discussions that we are hearing globally, especially particularly in the US, is that the Fed is not going to be taking any immediate action because they want to give a chance to see how the impacts of COVID, especially the supply side limitations, etc., that need to be ramped up to where it was pre-COVID. So there is a wait and watch policy, I think, that the Fed is applying, and there's actually a divided house also in terms of what should be done. In the event that there is, a similar taper tantrum type event, my sense is that it's going to be more phased out, less dramatic or overnight, and that will give an opportunity for emerging economies like India to be able to have a more well thought out response. There is also definitely, global demand, and where capital flows will depend on the actions taken by the Fed. And that's very much, I think Geeta Gopinath is very right in what she says, that it will have an impact in terms of flows. One of the things that we have been discussing in India is also mobilizing domestic capital for sectors like infrastructure, because India also has a very large pension pool of capital, which has never come into really either private equity or the infrastructure sectors in any significant way. So I would say that, these kind of changes may become catalysts for the Indian domestic capital pool itself to start getting allocated to some of these sectors which have not received the benefit of that fund flow from domestic sources.
Thank you. Well, one sector that has, a lot of global money has come into is tech and Indian startups through foreign venture capital funds, which have been at records. Ashleigh, what's that been like? Have you ever seen anything like this? And is this vulnerable to I think we may have.
Yeah, I'm here. Can hear you.
Oh yeah. So have you seen anything like this? And do you think this is vulnerable to a change in global liquidity conditions?
What uh, 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 what is sentiment in the US? Uh, uh, for scenario tomorrow. Uh,
Sorry, Ashni, we're having some. I think there's some technical difficulties. I'm struggling to hear you. Sorry to interrupt you. Maybe we can come back to you. Um, is that Rashesh? Do you have any thoughts on this, or indeed on the question about more broadly what you how independent Indian capital markets are on global liquidity and foreign investor flows?
Rashesh, you may be on mute.
Oh,
Yeah.
okay. Yeah, thanks. Sorry. So I was just saying, I think if you look at the actual numbers, India has a lot of capital onshore available. Household savings in India, I mean, our total savings are close to $1 trillion a year in India. I think what we get from foreign investors is about $100 billion a year if you put everything together. However, I think the foreign investors or the foreign liquidity is highly correlated to Indian liquidity. So when global liquidity starts tightening, exchange rate, interest rates in India going up, all those could be the outcome, and liquidity does matter. So I think foreign liquidity does impact Indian liquidity and hence Indian markets in that sense. The other key thing that the foreign investors do is they bring in a lot of risk capital. The challenge in India has been, and we say that very often, that India is a country of savers but not a country of investors, because a lot of the local capital is very risk averse. And we see that in the banking sector, what Ashnil was talking about earlier. We see that even in the equity markets. So if you see historically, foreigners have provided a much larger amount of risk capital, whether it's in private equity, venture capital, early stage opportunities, even the private credit funds that I was speaking about. A lot of the money is coming from foreign investors. So I think foreign investors have been a lot more innovative, have been more risk taking. They also take us, the capital they provide is slightly more flexible and longer term, which is what India needs. While a lot of our onshore capital is very inflexible, very shorter term, a large part of the Indian household savings go into bank deposits, which are liquid overnight. I mean, for those of us who are not aware, I think any deposit in the bank is callable at a cost very often if it's different kind of deposits. But so the asset liability mismatch in the banking sector does not allow them to really take long-term view as well as take risk view. So I think we are very starved of risk capital. It's improved a little bit, and we saw a couple of IPOs recently, which is the first in India. Otherwise, if you see most of the unicorns, most of the new age companies, if you see the capital that came to them are still international investors. The global PE firms, the global VC firms are the one who are still providing a lot of capital, and we see that in the market also. A lot of the mid caps and all are still, I think, the foreign investors, hedge funds, and others who buy them. So I think India needs to move towards more risk taking culture, and it's a maybe another larger topic, and people have spoken about it. But Indian capital is a lot more risk averse. So I think we'll continue to depend on foreign capital for quite some time. I would think, though it is changing. I think we were much more dependent on foreigners 10 years ago. The dependency has come down. I think it will come down even further over the next 10 years. But foreign investors are, again, like the equity markets, a barometer of the risk capital, of the liquidity in the world. And hence, I think they play a very important role. They also are quick to go in and out when things change in the country. And that also is very useful, because Indian capital, like Indian insurance companies, LIC and all, they have a lot of money in equity markets in India, but that's trapped in India. It can't go abroad. But foreign investors can come into India, and if they think the India story is not playing out, can go out. So they do impact the markets in that way also, because they are more agile than the Indian capital.
Great, thank you. Let's just try and answer a couple of audience questions quickly. One that has already been alluded to in this conversation. How do you see the government and RBI support for regulation compliance to build and strengthen the green bond market in India? Does India need to partner with any developed country for advisory and on policies and frameworks? Is country rating an issue? Do you see an improvement in rating in the short term? On the green bonds, would anyone like to take that? Maybe Yelan, you mentioned green investing.
Sure. I think there's been a lot done. We see a significant proliferation of green bonds. We encourage companies, we invest directly in the companies with green bonds in mind. Of course, we have some controversies as well on the policies. So some of them coming from the government itself. But I think the main important progress that we see is from the companies themselves who are taking initiative and really trying to green their operations. And banks are clearly there to facilitate that. I think on the regulatory side, the big theme that I believe is really important for emerging markets overall, not only for India, is to create this mechanism that will allow us to transfer the carbon offsets, especially for countries like India, where it's very difficult for political reasons to agree to certain demands from international community today for developmental process. It's quite controversial. You have to find a way to compensate or offset the carbon in general. So I think we've seen some countries, the European Union has been obviously the first one to launch the carbon trading mechanism. Now China has launched a similar market. I think India needs also to really move ahead. So I think regulatory environment is the right one for that. And I think the upcoming COP26 will present an opportunity for Indian government to create this push for that. So I think overall the desire to invest into infrastructure, as already mentioned by Anita, is there, especially into green infrastructure. Companies are there, companies are ready, they're willing to do that. And regulatory environment is also adequate, but I think there could be more done in order to be at the forefront of green investments.
So if I can just jump in, Benjamin, India has about $20 billion of green bonds. And as Yerlan mentioned, a lot of it has come from the renewable energy platforms. And we have invested in two such, and both have actually, one has done a domestic green bond, CLP India, and Azure has done two or three maybe green bonds for about $1.5 billion in total. And this is a market where, if you look at it globally, there's $42 trillion that are linked to ESG and green investments. So as Yerlan says, this is a great opportunity for India. And given on the real side, we have this target of 450 gigawatts of renewable power that we need to reach. Today, we've just crossed 100 gigawatts. So there's still a long ways to go. And I think this is an area where India can actually play a leadership role. One of the big debates we hear within India is on taxonomy for green bonds and green investments and so on. But I think there's a global consensus forming on these parameters with the IFRS's Sustainability Standards Board. So it would also be great if India could adopt similar standards and therefore have a greater ability to attract foreign capital in these areas.
Great, thank you. And just quickly, an interesting question. Compared to its emerging market peers, what is the perception of Indian regulation and corporate governance, including public sector enterprises? Would anyone like to take that? Yelan again, maybe?
Yes, sure. I think the perception generally is positive. There's been a lot of improvements. We seen some controversial situations as normal is in any emerging markets involving large corporate groups, of course, that has to do with the governance in terms of how the companies are run and maybe from the shareholder perspective, it's been maybe at times controversial, but generally speaking, the trend in emerging markets and in India is, of course, to improve the corporate governance as in general. The of course
I
there's
should probably. Sorry, I think I'll have to cut you off there. Apologies. We're just running out of time. Yeah, so thank you everyone for the discussion and for your participation. This session will be available for at least 30 days on the event website and will be followed shortly by a fireside chat between Nick Shalik, General Partner at Ribbit Capital, and Miles Krupper, the FT's Venture Capital Correspondent, about the future of finance. Please stick around. Thank you everyone again, and goodbye.
Thank you.
Thank you.
Bye-bye.
Thank you.
Hi, everybody. Welcome to our final panel of the day. It is a fireside chat titled The Future of Finance. I'm Miles Krupa. I'm a venture capital correspondent in San Francisco for the Financial Times. And I'm joined by Nick Shalik, who is a general partner at Ribbit Capital. For those of you who might not know Ribbit, they are pretty well known, at least here in the US, as one of the top performing fintech VC firms of the past decade. Some of their biggest bold name investments, Coinbase, Robinhood, Brex, as well as many in India, including Bharat Pay. I'll let Nick tell you a little bit more about that later, but they've been very active in India, and Nick has a lot of thoughts on where finance and fintech will be going in the next 5 to 10 years. Please don't hesitate to submit questions into the Q&A box. We'll have about 5 minutes at the end of the panel to take those questions. So without further ado, Nick, how are you doing?
I'm great, Miles. Thanks for having me.
Good. So Nick, tell us a little bit about how Ribbit became interested in India. What was the opportunity? What was the timing, and why was the opportunity big for you?
Yeah, for sure. So Ribbit was started in, we founded the firm in 2012, and the original thesis behind the firm was that we wanted to back software entrepreneurs who were going to build new financial brands. We thought that coming out of the financial crisis with the growth of mobile and digital channels, that there was an opportunity for entrepreneurs who knew how to build software companies to start building new financial services companies. And this was a domain that a lot of venture capitalists hadn't invested in historically, because these businesses tended to be regulated and capital intensive, and there was a perception that there were a lot of risks around them, and that it was very hard to compete with the incumbents who had distribution advantages and strong brands and strong relationships with regulators. So our bet was that things like the growth of mobile would sort of level the playing field. But we needed to go and find entrepreneurs that were really fast moving, really scrappy, really shrewd about how to operate in these complex spaces. And so that's what we set out to do. I think from the beginning, that thesis in our minds really applied in India as much as it did anywhere else in the world. We had to take a step-by-step approach to how we learned the market, and we were very, in our minds, respectful of the idea that we had a lot to figure out about how the Indian venture ecosystem and financial services ecosystem worked. So we didn't do it all at once, but if you think about the two components of our thesis, it was one, there'll be great software entrepreneurs who will enter the domain, and that they'll go serve, really underserved customers in new channels. And that was, India kind of epitomized that thesis more than anywhere. So,
right.
And then you see, over the years, and this happened, at different moments, as most folks probably know, but Geo opening up broadband to hundreds of millions of people, UPI opening payments innovation massively, now at $80 billion or more in payment volume, Aadhaar promising to enable digital KYC and transactions, smartphone users surging to over 700 million people. You map that against very low credit card penetration. I think the stats that I remember, something like 1/200th of the penetration that you'd see in the US, or 1/20th of what you'd see in China, or only, I think at one point, maybe back in 2014 or 2015 when we looked at it, saying, hey, look, there's less than 1% of the total insurance market that's online, and less than 5% of the population has insurance. We just thought these things would change in a massive way, and that created an opportunity that we couldn't ignore.
Right. So tell me a little bit about what you're looking at now at the early stage, maybe the top sort of Series A entrepreneurs, startup ideas. I mean, and how does that sort of compare to when you entered the country?
Yeah, So I'll tell you about a few areas that we're thinking about, but to maybe address your second question first, the biggest thing is the maturity of the ecosystem. It's evolved a lot, and that a great thing when you have a few successes, companies like PhonePe or Razorpay or Grow, and I'll reference some companies in our portfolio because they're the ones that I know and love, but there are lots of great ones. Or Paytm, they bring they bring the whole ecosystem along because they train a lot of talent, and something that's gotten us really excited the past few years, and that we keep seeing now is just entrepreneurs emerging from these companies. So if you think in our portfolio, people like Kunal from Cred or Lalit from Grow, they came from other tech companies. In Kunal's case is FreeCharge, in Lalit's case is Flipkart. Now we're seeing companies being started out of this early wave of fintech companies. So that's the kind of fundamental level we're trying to back great people, and that's what's driving us. In terms of areas that we're excited about, there's a bunch, but I'll name a few. One is health insurance. It's sort of in our minds, there's a massive open opportunity and need for consumers changing, government guidelines around employer-sponsored insurance that's creating tailwinds for the market. And then we look at investments that we've made in other parts of the world and the way that software entrepreneurs are reimagining how you underwrite risk, how you serve customers, how you bundle care delivery with the insurance component. And we just think there's a lot of room for maybe, multiple very big companies to be built in that space. We'd say the similar thing about digital banking, which is it's still really nascent, and there's obviously some very big companies going after consumer finance. But when we think about the profitability of something like the consumer lending business in a lot of segments in India, but the penetration of digital products is really low. We're companies, and we have a company in our portfolio called Epify, which is started by a great team out of Google from Taze, and focusing on salaried employees, but we'll, with a huge opportunity to expand over time. And then maybe at the broadest thesis that we're thinking about now, but I think is going to be really big for the next 4 or 5 years, is in the way that software companies will become financial services companies. So we're seeing many interesting software businesses in the B2B domain who are trying to organize, kind of become the operating systems for different kinds of small businesses or supply chains. So an example of this, where we're not an investor, but a company that we really like, is a business called FlowBiz that has a product called My Bill Book that looks like a platform for SMBs to create and manage GST invoices and other workflows. And it's really about helping small businesses launch, run their business, organize their financial lives. But you become, by being the software provider, you become the logical place for an entrepreneur to access, credit or payments or insurance or other financial products. And that trend is very broad, and I think will go on for a long time.
Right. You brought up consumer banking. What are the incumbents missing or not doing? Why is there such an opportunity for new sorts of consumer finance startups?
Miles, I think it's one of these kinds of questions where it's usually not one thing, it's 1,000 little things, and not all the incumbents will get it wrong. It's just, in our opinion, it's a very different mentality that goes into the way that you design a product and organize a company. If you think about your whole business as being a mobile first digital distribution business, I mean, COVID, as we all know, has really accelerated this trend. But all over the world, there are many consumers who have sort of thrown out the idea that they need to be able to go to a branch, or that they need to interact with a broker or some other kind of intermediary. And so if you think about the way a new company that says, hey, we're just going to build a mobile app, and we have to think about and reimagine every experience from origination to customer service through mobile, and the DNA of that company is really different than even a great traditional financial services company that is often organized by product lines, has systems that were built over the last typically 30 or 40 years, and has built an organization that rewards people for serving customers well offline. It's not that it's impossible for incumbents to build good mobile apps and compete, but it tends to be really hard. So I think that when you see the growth of things like Google Pay or Phone Pay, which I think we looked in 2019 together, the two of them were something like 190 million downloads, which is that's the same number as the next 8 biggest fintech apps combined in the world, just to give you a sense of the scale of the opportunity in India versus even other big emerging markets. You could say, hey, shouldn't the banks have built those products? They had access to UPI and they could have delivered the same P2P experiences. But I think, when you take a really focused company with the right DNA, that's often the kind of result that you get.
Right. With UPI, I mean, how has that impacted the opportunity set? And I guess, is there a chance even that UPI gets disrupted within the next 5 to 10 years?
I don't think UPI itself will be disrupted. I do think there'll be growth in other payment forms and other financial services rails, including ones that are interoperable with the rest of the world, like and maybe at some point we'll talk about crypto. But I think there's a real opportunity for the global financial services technology platform to change. But UPI it has been this amazing this amazing system. That really stands out because Ribbit invests all over the world. I mean, we really don't see anything quite like UPI. You see other markets, like in Brazil, the launch of Pix, which is another real-time payment system that's trying to learn from and capture some of the lessons of UPI. But when you think about like the experience you get with UPI, this like hassle-free checkout or registration or instantly settled funds, or the kind of security or trust improvements that come with it over older payment methods, it's really different, and the numbers speak to it, right? I think what I think of as the numbers is like almost 80% share of retail digital payments, and close to 30% of GDP is now running on UPI. And a lot of it is, obviously P2P volume, but I think you're now seeing something like, person to merchant, P2M, is 20% of UPI payments. So this is like the fastest change that we've ever seen. People often compare India and China, but the uptake of UPI and digital payments in India is meaningfully exceeding how quickly digital payments grew in China, if you kind of rewind 10 years ago. So I think it's really profound. And what it's doing from our perspective is it's creating an opportunity for these software entrepreneurs to come and build really new innovative models. So Bharat Pay, where we're an investor, and I think Ashneer was maybe speaking as part of this conference, it's the fast, for us, we look at every market, it's the fastest merchant acquirer in terms of growth that we've ever seen. When we first invested, I think they'd gotten to 600,000 merchants in 8 months, which was just sort of unheard of. And, to see what they are today, dispersing, millions of dollars of loans, providing SME banking products, kind of evolving into this broader app to help small merchants. That wouldn't have been possible without UPI, and it's pretty amazing to see. So I think UPI is here to stay and going to keep growing. And I think there'll be some other systems too.
Right. Are there still some areas in India where digital payments still have room to break through further?
Oh, 100%. I mean, in consumer, for all this growth in digital payments and everything I'm talking about, cash on delivery, for example, is still the preferred payment method of the vast majority of Indians who order online. And you understand why. It's a product that kind of solves a trust problem that people have, but that's not the case in other markets. And I think there are a lot of entrepreneurs that we're talking to now who are trying to build more frictionless experiences, lower cost, more efficient experiences where consumers get that same level of trust that they feel for cash, and from being able to see the product and know what they're getting before they pay, but also can do it digitally so they don't have the hassle of handling cash, which it's comfortable to a lot of people, but it's not as secure. It's it's more expensive. There's lots of problems with holding physical currency that I think would just over time see it go more and more kind of become a thing of the past.
Right. And where does crypto fit into all of this? There's a digital rupee under development, stable coins. We're seeing some interesting blockchain work out of India from Polygon. How do you see the ecosystem developing?
Yeah, crypto is this really hot button topic because it's just this brand new thing that's really, you ask 10 people about crypto, they'll tell you 10 very different things, or they'll pay attention to really different aspects of it. I think it's great that that central bankers around the world are seeing the value of blockchain-based systems and thinking about how to make their payment systems more efficient. In some ways, to me, the digital rupee is like the digital dollar that's being discussed, or the yuan that's been built in China. It's a great project, although I think India has already built a lot of the advantages that you could see from a modern system in terms of the way that UPI is working, but there's still benefits. I just don't I don't think of the digital rupee as the same thing as what's being built in these decentralized ecosystems on top of crypto assets like Bitcoin or like Ethereum, which are really software development platforms that anybody in the world can build on top of. So it's I think there's still a thought amongst many regulators or different folks in traditional industry that the kind of crypto genie can be put back in the bottle. But I think countries can decide not to be hospitable or not to want to have regulated crypto businesses on their shores. I think it's a mistake, but they can't stop this this kind of global ecosystem that's developing, because ultimately it's just sort of software development. So when we see projects like Polygon, which is now a prominent crypto asset-based development project that's been built on top of Ethereum, it's one of the leading scaling solutions on top of Ethereum, kind of coming out of India, or then we start to see this vibrant decentralized finance or DeFi community being built on top of things like Polygon. Like we've looked at a few companies recently that are new platforms built on top of Polygon. So you start to have these platform dynamics emerge. I guess our thought is just, wow, India has this huge advantage in the global crypto economy because it's this market that is so full of talent around software development. Kind of crypto can be this internationally neutral development platform. India is a huge recipient of remittances and does a lot of cross-border business and has this very digital native payment system that's been developed around UPI. India should be a place where crypto really thrives. I wouldn't say that's the case right now, though, Miles, because there's a lot of uncertainty around how crypto is going to be regulated in India. And obviously speak from a very biased point of view, but I think the smart thing for India to do would be to embrace crypto, think about how to make it safe and secure for consumers who want to invest in it, but then take advantage of this is really a shift in computing and how applications are going to be built, and try to make a big part of that happen in India.
Right. Does the sort of evolving regulatory landscape in India, does that give you caution about investing in crypto projects in India?
It definitely does. Although we also, as a firm, try to be comfortable with the idea that we can take that risk and that we can bet on ultimately regulators want what's best for consumers. They want to lower barriers to access. They want to make financial services more efficient, more accessible. And we think time will show that people tend to think about crypto just based on the headlines, and the headlines talk about speculation and in cryptocurrencies. That's definitely part of what's happening. But that speculation also is fueling a huge amount of investment in an ecosystem that's building kind of a new financial system, a new way of delivering financial services. And I think nowhere stands to benefit more than markets with a lot of people who have access to the internet, and a lot of people who would like better access to financial services. So people often talk about kind of the 50 million consumers, or people use different numbers, but let's say the 50 million consumers in India who are well served, and then the rest that don't really have access to these modern digital services. our bet would basically just say, like, look, today's fintechs or traditional financial institutions, they may serve the next billion consumers, but it's probably more likely that some new technology actually makes it, easier or more accessible. And I think crypto has the potential to do that. So we think it's a big enough opportunity that it's worth betting that regulators will, kind of ultimately see it as something that is really important to regulate, but to embrace.
Right. We're hitting the 5-minute mark, so I want to get on to audience questions. There's one that stands out to me here. Nick, are you worried about booming valuations of tech companies and fintech companies? I'm curious specifically about India because just talking to some investors who were very early in India, it was often the case that you could find much cheaper deals in India than you could in the US or other sort of developed countries. How do you find the sort of price and risk reward environment right now?
Yeah, the things I'll say will be true about anywhere in the world. It's a really, it's a very, both a tough environment and a really exciting environment. It's a tough environment because the competition from global investors is really intense. And that brings, very high prices, large rounds, very deals. That's happening. That's happening in India as much as anywhere. At the same time, that also means entrepreneurs are raising a lot of money, doing it quickly, and getting those resources to invest in making their businesses a lot bigger. So we look at a business like Grow, where we're investors. I think they're at nearly 10 million monthly active users. It's become a very big business. They've raised money at high prices. But they're, something like 70% of their customers have never invested before, or, 60% of their customers live outside the top 6 cities. And I cite those stats just because the addressable opportunity for them is so huge. So when I think about something like, Grow, I see just boundless potential. And if they're able to raise money from international investors or domestic investors who are excited about that, I think that's a more important thing for us to be part of than, for us to put our energy towards worrying about valuations. From an investment standpoint, we just have to be really picky about backing the entrepreneurs that we think can attract those resources, can absorb them, and can build the teams that make good use of them.
Right. We have another question asking how India compares to other emerging markets in terms of fintech potential, in terms of adoption and maybe the total market. I know you're very active in South America, Latin America as well.
Yeah, there are other markets that are exciting, but I don't think there's another one that, at a fundamental level is as exciting to us as India. And the reason I would say that is because the rate of change in India, venture capitalists look for things that are changing. And so we'll, for example, spend a lot of our time investing in the crypto ecosystem now, because all over the world, crypto is changing really fast. There's a huge amount of development. This sort of permissionless nature of crypto is creating an opening for software entrepreneurs to come in and build something new. It's that openness that really brings a lot of innovation. And so I analogize that to something like UPI, which has really kind of blown open the doors for software entrepreneurs to say, hey, there's a more accessible way for consumers and businesses to pay. And if we build great companies, great software, we can reach them. That combined with Kovid, with this sort of trend that's happening everywhere for things to become digital first, is just leading to really rapid change in the way things are done in India. And then there's kind of the macro picture that we described earlier. So there are analogous situations, in markets like Brazil. But I think India, the fundamentals are as good as anywhere. It doesn't mean it's a panacea to invest in India. I think something that foreign investors like us have to worry about a lot is how hospitable is the environment going to be for us to invest and be able to generate returns and realize those returns. It's really hard to get money in and out of India. Some other investors have struggled with tax rulings. I mean, I think my honest opinion is India could make it easier to attract foreign capital if that was what regulators wanted.
Right. Well, I think that's an interesting note to end on. Thank you again, Nick. Really appreciate that you took some time to share all these thoughts with us. For everybody who's watching, a recording of this will be available for at least 30 days on the event website. Our next webinar in the Financial Times India Express series will be on November 23rd, and it'll be focusing on green economy and new technologies therein. So thank you again to all of our listeners. And I realize it's getting late in India, so everybody have a good evening.